Yes, sir, you can start.
Good evening, members, and welcome to the 28th meeting of our study circle, Borivali Central City Study Circle of WISC. Before we start the meeting, let us raise for our institute motto.
येष सुप्तेषु जाग्रति येष सुप्तेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्मिमाणः निर्मिमाणः तदेव शुक्रं तद्ब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यपि कश्चन एतद्द्वैता 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 एतद्द्वैता.
Welcome back, members. As you know, members, the Finance Act 2022 has introduced a new section 194R dealing with the perquisites or tax TDS on benefit and perquisites. It's a very complicated topic as such. The bare provisions are minimum, but you will get n number of issues under that. So to have a technical view of that, we have invited CA Ravikant Kamath ji, who will be taking the seminar. Not taking much of your time, I will request our past convener Kiran Mehta ji to briefly introduce him.
Thank you, Vijay. It's my privilege to introduce today's learned speaker, Ravikant Kamath ji. He's a chartered accountant by qualifications. Yeah, and he's working with the ENY LLP and having a 23 years of experience and specializing in the business tax advisory and the people advisory taxation. He also works closely with the tax policy team in assisting the government and industry chambers on direct tax policy issues. Ravikant Kamath ji joined EY in 2008, and prior to joining ENY, he worked for 10 years with Messrs. PD Desai and Company Chartered Accountant, a boutique tax firm headed by Sri Pinakin Desai ji, a well-respected senior tax consultant professional. Presently, he is also partner in EY and heading the direct tax knowledge and solutions team. Ravikant Kamath ji has presented various seminars and conferences organized by various professionals, associations, and industry chambers. With this brief introduction, I request my colleague to present a memento to CA Ravikant Kamath ji. Welcome, sir. Sir, you can start the session.
Thank you. I'll share the screen first.
Also, sir, on behalf of our Borivali Central City Study Circle, we will contribute rupees 500 towards the CABF fund as your contribution to the fund. Thank you, sir. Now you can start your session.
Thank you. I hope my screen is visible now.
Yes, sir.
Good evening, friends. Thank you to the office bearers of Borivali Central CP Study Circle, Pradeep ji, Kiran ji, Vijay ji, and Sharad ji, who had reached out to me for giving an opportunity to share my thoughts with all of you on this Saturday evening on this very controversial topic of TDS under 194R, which is on the business perquisite, and as rightly pointed out by Vijay ji, brought in by Finance Act 2022, has already become applicable from 1st of July 22. The section as such is a very small section, only three subsections. However, the controversy has arisen after 16 June when the CBDT issued the circular on this for the removal of difficulties, which are basically the guidelines for removal of difficulties, which contains 10 FAQs. And each of those 10 FAQs has given rise to further issues, confusion, controversy, and whatnot. So, I thank the Borelli CP Study Circle for, being with all of you and trying to share my thoughts. In this session, what I intend to do is, my presentation is only of around 37-38 slides. So I'll express my thoughts, and later on, we will keep the session very interactive. And, I expect to interact with all of you. You are free to express your doubts. You can put your questions on the chat window. And at the end of after my presentation, we will take up one by one and try to, resolve each and every member's doubt to the extent possible. So let me straight away start off with my presentation. Now, for section 194R is a TDS provision. So it is not creating a new tax. It is not changing any provision relating to the computation of income. It is just a measure of collection of tax. Now, when we read the explanatory memorandum, what it said was that 28(4) is there on the statute. It taxes the value of any benefit or perquisite, whether convertible into money or not, arising from the business or the exercise of a profession. However, many recipients do not report the receipt of these benefits in the return of income, and which leads to furnishing of inaccurate particulars of income. There is no tracking. Finance Minister in her speech said that there is a tendency on the part of the businesses to pass on benefits to their agents as a business promotion strategy, which is taxable in their hands. But right now there is no TDS provision. So therefore a new TDS provision is proposed if the aggregate value exceeds 20,000 in a financial year. And the explanatory memorandum then further on goes to say that because of these reasons, a new TDS provision is proposed to track such transactions and to widen and deepen the tax base. And it covers payments to the residents. Now, so in the explanatory memorandum, it is very clearly laid out that, this is because this section has come because of 28(4). There is a specific reference to 28(4). But as we all see that when we come to the circular, somewhere this section they have diluted. But before we go to the TDS provision, because the explanatory memorandum and because the language of the provision is very similar to 28(4), first let us spend some half an hour only on understanding, or for many of you it could be refreshing, what is 28(4) all about, how it has been interpreted by the courts, what is its scope and ambit, which transactions are covered, which transactions are not covered. After that conceptual understanding and discussion, then we move on to the TDS provisions, and then we move on to the FAQs in the circular, and then try to analyze that in the light of all the principles that have been laid down by the judiciary on the interpretation of 28(4), how far is it relevant, where all there is a contradiction, where all there is an alignment, and what should the taxpayers do. So let's start with the basic fundamental understanding. Next 7 or 8 slides are only on 28(4). Now 28(4), as I said, as we saw, it talks about benefit or perquisite arising from a business or carrying on of a profession. Now benefit or perquisite, I think you would have seen many times. It's there in salary chapter. If you look at the dictionary meanings, what is benefit? It is explained to be an advantage, profit, something of value for the recipient, something good, something which benefits the taxpayer or the assessee. Perquisite similarly has been defined, it's a privilege, benefit, amenities, gain or profit, personal advantage, some personal obligation met by another person. All these are, various meanings of perquisite. So benefit or a perquisite, we all understand in a very general way. When this section was introduced, 28(4) was introduced in 1964, the circular, CBDT circular, which explained the object of this provision, that is circular number 20D, gave an illustration where this section will apply. So the illustration which was given was the value of rent-free residential accommodation secured by an SSE from a company in consideration of the professional services as a lawyer rendered by him to that company. So the example which was given was, there is a personal benefit given to the lawyer. Lawyer is rendering professional services, but he is given a personal benefit of a rent-free residential accommodation by the company, and it is in consideration of the professional services rendered by him. Now, why was this required? Now, let's say the lawyer is paid professional fees of 10 lakh rupees. So that 10 lakh rupees you do TDS under 194G, it will be captured in his return, and it will be captured in his bank account, and he will offer it to tax. But some benefit which you give him to him kind, if no TDS is done, or if it is not offered for taxation, let's say the value of this rent-free residential accommodation is 2 lakh rupees. Now, if it is not offered, then his business income is understated by 2 lakh rupees. Whereas, if you consider the value of that benefit, now that benefit he is getting it only because he is rendering professional services to the client. So therefore, it is a benefit or a perquisite which is arising from the rendering of professional services, from the exercise of a profession. And therefore, it is clearly captured within the scope of 28. Now, if you take this example and try to wonder that if 194R was not there, how would you have treated this value of rent-free residential accommodation? Would you not have deducted tax under 194G? Because 194J covers fees for professional services. So any sum paid by a fees for professional services. So is it that 194J only covers monetary payments, or is it wide enough to cover even non-monetary payments? We will discuss that in greater detail. Now, if you look at the various court decisions, this benefit has been explained. The benefit or a perquisite should represent a real income and should not be hypothetical income. So in Excel Industries, it was concerned with the export subsidies, which you had to export. So export took place in 1 year, and then you get an import duty exemption. And that import duty exemption can be claimed when you import the goods. So the question arose whether this benefit is taxable in year 1 when the exports are made, or in year 2 when the imports are made. In the books of account, these benefits were recorded in year 1. But for tax purposes, the taxpayer said it is not taxable in year 1. It will be taxable only in year 2 when I actually make a claim when I actually make an import and make a claim against the government. And Supreme Court said that yes, in the first year, it is just a hypothetical income. It will become real income only when there is an enforceable right in favor of the taxpayer. So that enforceable right arises only when he makes the imports and puts up the claim before the government. Now, this concept we can expand to even business perquisites. Let's assume there is a reward system for the sales incentives are given by way of reward points, some loyalty points are credited. So in that case, this issue arises that as and when the sales are happening, you may award some reward points which are notional in nature. They cannot be monetized, they cannot be sold, mortgaged, gifted, anything. But after it reaches a particular level, then the dealer or the distributor is entitled to redeem it. And he can say he can claim cash or he can claim some item in kind. So at what point of time should this taxation arise? So arguably relying on this principle of real income, the conclusion would be, or the view would be, that this taxation should arise at the time of redemption of the points for cash or in kind, and not at the time of mere credit of the notional reward points. Moving further, in what all cases, what are the illustrations in which this 28(4) has been upheld in various cases? So in this slide gives you different examples where actually the courts have said that in these particular cases, the 28(4) is triggered. The benefit or the value of the benefit is arising from the business, and it is taxable, business or the profession, and it is taxable. So for example, first is this Ram Kripal Tripaঠি's case, Allahabad High Court decision in 1980. He was a preacher, he taught Vedanta. So the court said that is a vocation, and some disciples who benefited from his teachings gave him some money to buy a car. So they, all contributed some 16,000 rupees and bought a car and gave it to the taxpayer. Now this, the taxpayer said was a gift, but the court said that no, this is arising from his vocation, this is profession, and therefore it is taxable as his income under 28(4). The next is you have net of tax arrangements, normally with the non-residents, where you say, okay, I will pay you 100 rupees net of tax. Any tax liability will be borne by the consumer or by the buyer of that service. So in that case, so the SSC's tax liability is borne by somebody else as part of that consideration under the net of tax arrangement. So for example, the base consideration is 100 and say the tax rate under say 115 is 10%. So therefore, the payment which I receive may be 100, but the payer also, pays 11 rupees, because if it is on net of tax basis, then you need to gross up under section 195A. So therefore, total amount that which I see in my TDS certificate is 111, and 11 rupees is deducted as a tax. So that 11 rupees, which is my income tax liability, which is paid by my customer, is also a benefit or a perquisite which is arising from my business, because it's a supplementary consideration. My personal liability, income tax, is a personal liability borne by my customer. So that is a benefit or perquisite. Next, in case of the subsidies. Now, before the amendment by Finance Act 2015 by way of insertion of 224(18), there was always a distinction between capital subsidies and revenue subsidies. And the test for distinguishing between them, which was laid down in Ponni Sugars, Sahani Steels, etc., was that what is the purpose of giving that benefit? If the purpose is to enhance the profitability, for his trading operations, then it is revenue in nature. But if the purpose is something else, which is like moving to an industrially backward area, generation of employment, acquisition of capital asset, then it is in capital in nature. So revenue subsidies are taxable as revenue income. Capital subsidies are not taxable. They are capital receipts. So wherever they are of a revenue nature, the courts have said that, these are benefits, perquisites under 28(4). Of course, thereafter, you had in 1990, there was a retrospective amendment, whereby certain benefits like import entitlements, cashback, the cash entitlements, etc., were specifically brought in as an income, but taxed as an income with retrospective effect from 1962. And that was because of a special bench decision in case of Gedore Tools 25 ITD, which said that some of these benefits are of a capital nature. So to resolve that dispute and to make the law very clear, provisions were introduced, 28, 18, 3A, 3B, etc., which covers various types of subsidies and export benefits. Now, in case of Supreme Court ruling in case of Rajaram maize products, the subsidy was a power subsidy. And the power subsidy means that suppose the per unit cost is 10 rupees, the taxpayer had to pay only 4 rupees. And 6 rupees was paid to the electricity distribution company by the state government. Now, how the controversy would have arisen? Suppose, that is not very clear from the ruling, but what I believe is, if the taxpayer had claimed only 4 rupees as his purchase cost, then perhaps there would have been no problem, because this 6 rupees benefit automatically gets taxed as an income. But perhaps what the taxpayer would have done is, and in many cases taxpayers have done that, wherever they feel subsidies of a capital nature, that they claim a deduction for this 6 rupees. This power cost is not 4 rupees, it is 10 rupees. So 6 rupees is claimed as a deduction by way of power cost. And the corresponding credit of 6 rupees is claimed as a capital receipt. And then the litigation in the tax arises whether this 6 rupees is a revenue subsidy or a capital subsidy. And ultimately, in this particular case, it was held by the Supreme Court that this is a revenue subsidy. Similarly, in case of metal rolling works, Bombay High Court, it was concerned with sale of import entitlement. So it was held to be revenue in nature, covered by 28(4). In Nagesh Knitwear's case, it was sale of export quota. That was also held as a benefit under 28(4). In Bombay High Court ruling in case of Protos Engineering, he was like taxpayer was like a commission agent. It received the monies from the customers. It spent the monies for the customers. It received advances. And then there were certain advances from the customers which customers never claimed. And then the taxpayer credited it to P&L account. And there also the controversy arose whether it is taxable, not taxable. And the court held that this is a benefit or a perquisite. It is convertible into money. It was received way back. But then this is a benefit which is convertible into money, and therefore it is taxable. Next is Boeing versus CIT, Madras High Court ruling. There the taxpayer was a dealer, and it got ambassador car. And what the scheme was that if you purchase more than 8 lakh rupees worth of suitings, then an ambassador car would be given. Now, instead of the ambassador car, she took the taxpayer took 50,000 rupees from the company, and that was held to be a benefit or a perquisite under 28(4). Next is this Chennai Tribunal decision, Imbavali. There again, she was a dealer. She was selling electronic items for companies like Onida and Godrej. And in appreciation of her marketing efforts, Onida and Godrej, they sponsored their foreign trip for the entire family, the SSC, the wife, husband and son, to say Singapore. And there, that benefit, the cost of that foreign tour was considered as taxable as a 28(4) benefit. Then we have this freebies to doctors. We have circular of 5 of 2012, which said that pharma companies which are giving various freebies which are in violation of MCI guidelines, they are taxable in the hands of the doctors. So the taxability would be arising under 28(4) because this is in addition to their professional fees which they receive. This is sort of a supplemental source of income. Next, we have certain decisions associated with film personality. So it becomes very easy to remember. So first is this Priyanka Chopra. She acted as a brand ambassador for Toyota NDTV campaign, environment campaign, and she received a Toyota car in consideration of being a brand ambassador. She also acted as a brand ambassador for a watch company, so she received a watch in consideration, which she had, if she could keep for herself, she could use it for personal purpose, she could use it for professional purpose. Now these were held to be benefits under 28(4) as taxable as business income. Now these are the examples where courts have explained where 28(4) gets triggered. And if you see, the normal theme is that it is something in addition to your regular source of income. Your regular source of income is professional fees, but you receive something in kind that is also your income. So 28(4) covers those types of income, something which is supplemental to your regular source of income, and it should be having a nexus with your business or profession. Now this is one slide which shows the examples of what are the benefits covered by 28(4). Next 4 slides are examples which shows that those benefits or perquisites are not covered by 28(4) for various reasons. So let me start off. The first and foremost is now the language of the provision, whether it is 28(4) or 194(r), it says benefit or perquisite convertible into money or not, arising from the business or exercise of a profession. So therefore, one of the main condition is it should have a nexus with the business or the profession. So if the benefit or a perquisite does not have the nexus with the business or profession, it is not covered by 28(4). And we have a series of cases. So for example, an MLA got a gift of a car from people of his constituency, which the court held that it was not arising, it was a bit of love and affection which the people had towards that person. Next is the tax liability. Now, in the earlier slide, we said under a net of tax arrangement, if you receive any consideration and that tax liability is borne by the customer, the tax liability is also benefit under 28. But this is a case where there is a different scenario. Western Rolling Mills. Now, Western Rolling Mills, the taxpayer had borrowed money, it was paying interest, and that borrowed funds was diverted to a sister concern where no interest was charged. So naturally, this was much before the SA Builders Supreme Court ruling. And in this case, in the assessment, it was held that the interest expenditure is not allowable as a deduction under 36(1)(3), and therefore the taxpayer had to pay higher tax. Now, this higher tax, which it had to pay because of the assessment, was reimbursed by the sister concern who got the benefit of the interest-free loan. Now, there the Bombay High Court said that this is not arising from the business or profession, because the disallowance was made because it was not used for business purpose. So therefore, this reimbursement of tax liability is not taxable under 28. So it says, depending on the facts, bearing of income tax liability under the first situation where it was a supplemental source of income, that it was considered as 28(4) benefit, whereas over here, it was held that it is not covered by 28. Next, we come to, another film personality, Shah Rukh Khan. Now, he received a gift of a villa in Dubai from the builder of that, villa. Now, the tax department tried to argue that Shah Rukh Khan had gone to that, annual function of that company. He had addressed the employees of that company, and therefore he received this for acting as a brand ambassador. Whereas the tribunal held that no, he did not act in any commercials or before the public. The promoter of that company gave him just because of his love and affection, because he was his close friend. So villa was given just out of personal relationship. It was a unilateral gratuitous gift, and it was not arising from the acting profession, and therefore it is not a benefit under 28. Next is Bhavnagar Bone and Fertilizer, Gujarat High Court decision. Here there was a firm and there was a company where the common partners and directors were there, and they were having transactions. But the firm then discontinued its business, it sold its business, and then for a long time it did not have any business. Now in the books of the company, there was a credit balance of that firm. And after say 14 or 16 years, it was decided to be credited to capital reserve in the books of the company, because the directors of the company were the partners in the firm. So they took a decision that let us appropriate this to the capital reserve. Now here the Gujarat High Court held that the business of the firm had discontinued long back. So this benefit, if at all, is not connected to any business carried on by the company with that firm, and therefore it is not taxable. So first condition is nexus with business or profession. That is a fundamental condition. Next is monetary, whether monetary or non-monetary in nature. Because what is mentioned in 28.4 or 194R is benefit or perquisite, whether convertible into money or not. Now this phrase is very important, whether convertible into money or not. Now that phrase has been interpreted by Supreme Court in Mafatlal Gangabai to say that that means what is sought to be covered is only the benefits or perquisites which are in kind, which are non-monetary in nature. So in that particular case, Supreme Court was concerned with section 40A5, which provided for a disallowance, artificial disallowance of benefits or perquisites provided to the directors, etc. And directors above a certain limit. So there they said if any cash like HRA or conveyance allowance was paid, that will not come within the scope of 40A5 because those are monetary in nature. Whereas 40A5 covers only non-monetary benefits. It uses the phrase benefit or perquisite, whether convertible into money or not. In case of 28.4 itself, you have a Supreme Court ruling in case of Mahindra and Mahindra, which was concerned with the waiver of the loan, where the taxpayer had got the benefit. It had taken a loan for the acquisition of a capital asset, and then the loan, the lender underwent merger, amalgamation, and finally it was waived off. Now in that, whether it was the issue arose, controversy arose, whether it was taxable under 28.4, 41.1, or it is as a regular business income, which the courts, Bombay High Court as well as Supreme Court said that it is not taxable as a business income. Specifically on 28.4, in one paragraph of the Supreme Court ruling, Supreme Court said that here, 28.4 talks about benefit or perquisite, whether convertible into money or not. So therefore, it covers only non-monetary benefits. Whereas the waiver of the loan, the benefit is in the shape of money, and therefore it is not taxable under 28.4. Another important Supreme Court ruling is Salgaokar's case. There, the director had received an interest-free loan from the company or a deposit from the company. Now, in this particular case, again, it was concerned with 40A5, read with section 17.2. And the issue before the court was whether this interest-free loan given to the director is a benefit or a perquisite in the hands of the director. Now, here the court took note of the legislative development that in 1984, then Taxation Laws Amendment Act was passed, which proposed to bring in a specific provision in section 17.2 as well as 40A5 to tax this interest-free loan or a concessional loan. However, before that section could take effect, the Finance Act 1985 deleted that provision, and that time the explanatory memorandum said this is as a measure of relief for the salaried taxpayers. So therefore, the Supreme Court said that you need a specific provision like the one which was proposed in 1984 to tax the benefit or perquisite which is arising from an interest-free loan. Otherwise, it is not a benefit or a perquisite. Now, if you see the further legislative development, now in case of salary, you have a 17.2.8 which talks about fringe benefit, and you have Rule 371 which talks about interest-free loan or an interest concessional rate loan where the interest perquisite is computed by benchmarking to the SBI rate of interest. So you have a specific provision in salary chapter to tax interest-free or concessional loan. But in business chapter, you only have this provision, benefit or perquisite, whether convertible into money or not. And you have the Supreme Court ruling in case of Salgaonkar, which says that interest-free loan or deposit is not a benefit or a perquisite in absence of a specific provision. Next, you have this Delhi High Court rulings in case of Asian Hotels and Bharat Hotels, where same principle has been reiterated, that if you receive the interest-free rent deposit from tenants, it is not a benefit or a perquisite. So, absence of business profession, then monetary benefit not covered. Next is benefits in relation to acquisition of capital assets. So, you have several rulings which have said that which a benefit or perquisite or some benefit you receive in the course of acquisition of capital asset, that does not get covered under 28(4). So for example, in case of this motor machinery tools, it was a motor machinery tools, SSC was a dealer for the agricultural equipment. And from the manufacturing companies, it received an amount of 4 lakh by way of a credit note for the purpose of acquisition of a delivery van with the logo of the manufacturer companies. Now this taxpayer spent around 5.5 lakhs, roughly around 5.5 lakhs on that vehicle. And what it did was it reduced 4 lakh rupees because it received a credit note from the manufacturer, and it claimed depreciation only on 1.5 lakhs. The tax department tried to say that this 4 lakh rupees is a benefit or perquisite under 28(4), which this Calcutta tribunal held that it is in the capital field, it is in relation to acquisition of a capital asset. And under 43(1), the actual cost of the asset is to be reduced by any amount which is met by another person. So this 4 lakh rupees comes within the scope of 43(1), and you will get a reduced depreciation allowance, but it is not a benefit under 28(4). Similarly, another Calcutta tribunal decision in case of PwC, where it received a grant from its foreign member firm for acquiring some Indian company. So that was a capital asset. So it was a subsidy or a grant received specifically for the purpose of acquiring a capital asset, and it was held that it is not taxable under 28(4). The next is very interesting decision of special bench of Delhi Tribunal in case of Indigo, Interglobe Aviation. As we all know, it is engaged in the business of operation of airlines for carrying the passengers and cargo. Now, it has to purchase aircrafts, or normally the industry practices, they lease the aircrafts, and there are specific leasing companies. It's a big industry, Irish companies who give the aircrafts on lease. Aircraft manufacturers are very few, like Boeing and Airbus and some other smaller aircrafts. Now, Boeing or Airbus, they don't manufacture in all the parts of the aircraft. Some of the critical parts like aircraft engine are manufactured by some other manufacturers. For example, you have Rolls-Royce, CFM, Pratt & Whitney, who manufacture the aircraft engines. Now, they manufacture the aircraft engines and give it to the aircraft manufacturer, say Airbus. And then the Airbus completes the entire aircraft and delivers it to Indigo. Now, Indigo had to purchase aircraft for its business. This aircraft engine manufacturer, who does not have a direct relationship, but in order to provide an incentive to Indigo to select its engine, it gave a credit note by saying that I'm giving you a credit note in consideration of Indigo selecting that manufacturer, aircraft engine manufacturer, for the purpose of installing those engines on the aircraft. Now, again here, the special bench held that this is in a capital field, and it's a grant for acquisition of a capital asset, and this benefit is not derived from the business of buying and selling of aircrafts. Indigo is in the business of operating airlines, so it is not a benefit which is arising from the business of carrying of the passengers and cargo in an airline. So there, it is a transaction for the acquisition of capital asset. It may be related to the business. The transaction of acquisition of capital asset may be related to the business, but the benefit is not arising from the business. So this is a very important principle which is laid down by this special bench ruling. Similarly, in case of subsidies, as you said, revenue subsidies taxable under 28(4), but capital subsidies, which were held, like for example, in this case, India Cements, it received an import duty subsidy for imported capital asset. It was held to be not covered by 28. So this is another class where some benefit is related to acquisition of capital assets. The next category is transactions are on capital account. They are of capital receipts in nature. So the classic example is of the subsidies which are given for the purpose of encouraging to moving to a backward area. So in case of PJ Chemicals or in case of Ponni Sugars, etc. So these were held to be capital receipts and not taxable under 28(4). Mahindra and Mahindra ruling we discussed, waiver of a loan which was acquired for acquiring fixed assets. And one of the cases, there was a bunch of cases. In some cases, the loans were acquired for acquiring fixed assets. In some cases, there were working capital loans. But all the cases were decided together. And the conclusion or the reading of the professionals of that ruling is that it also covers loans of working capital loans, like solid containers of Bombay High Court ruling had said that because it's a waiver of a working capital loan is taxable. But the Supreme Court has reversed that ruling. Similarly, certain Delhi High Courts which has said that some roll tenors where they had said working capital waiver of working capital loan is taxable as business income. That is read as being reversed by Supreme Court in Mahindra and Mahindra case. More specifically, Madras High Court ruling in case of Ramaniyam, where that Madras High Court had taken a view contrary to all the other high courts, was that the loan which is used, waiver of a loan which was used for the business, there it was a real estate developer. That loan, waiver of the loan is taxable under 28. That was the ruling of the Madras High Court. It went to the Supreme Court and it was considered along with Mahindra and Mahindra. And Supreme Court reversed that ruling and held that it is not taxable. The next transaction is like foreign exchange forward contract for import of capital assets. If there is an exchange fluctuation gain, it was prior to ICDS now 6 and the insertion of 43AA. These were held to be on capital account. So there are a series of decisions which have said if the receipt is of a capital nature, then it is not covered by 28(4). So in these two slides, we have seen 4 factors. The absence of business or profession, monitoring nature, related to acquisition of capital assets, receipts which are on capital account. So these are some of the transactions where 28(4) is not triggered. The next 3 or 4 categories are discounted purchases. So suppose you acquire in these 2 cases, first 2 cases, KNB Investments and Rupee Finance and Management. The allegation of the tax department was the investment made or the subscription made by these companies in shares of another company was at less than the fair market value. And therefore, it is a benefit or perquisite under 28. And this was rejected by the tribunals. And now you have a specific provision, 56(2)(10), to cover such type of incomes. The difference between fair market value and the purchase consideration is taxed as other source income under 56(2)(10). The Gujarat High Court decision in L-scope, another interesting decision. The taxpayer had acquired a business and it had to pay the purchase consideration by way of 5 annual installments. So it had to pay over the next 5 years. What it did was that it discounted those future payables at 12% and it arrived at the net present value. And it paid off that net present value in settlement of its liability. And therefore, there was a gain in the discounting of 12% was a gain which was recorded in the books. Now, this gain was held by the court, Gujarat High Court, that it is not, benefit or perquisite under 28(4). Next is this property. Company transferred a property to its director and wife at a discount to the fair market value. So there also it was under 224(4). Or 28(4), but the department tried to tax it under 28(4). Again, it was held that a discounted purchase is not a benefit or a perquisite because the income they will earn when they will sell that asset, they will earn the income, and that time that discount will get taxed as an income. Similarly, another amalgamation reserve. When you do an amalgamation, if it is under the accounting method, you have 2 methods. So if you do a purchase method or the acquisition method under India is what is called. And if the consideration paid is more than the fair value of the assets that you acquire, then it becomes goodwill. Okay, so that comes on the asset side. But if it's a reverse case, that the consideration paid is less than the fair value of the assets and liabilities acquired of the amalgamating company, then there is a credit, which you put it as capital reserve. Now, in this particular case, it was classified as an amalgamation reserve. And there the tax department tried to say that it is a benefit under, it is taxable under 28(4). So Madras High Court said, no, it is not arising from business or profession and therefore it is not taxable under 28(4). Capital receipts, continuing the, capital subsidies, etc. Share application monies which are forfeited or gift of shares from other companies. These are all capital receipts. Therefore, they are not taxable. Then comes reimbursement. Now, there's a classic case of Owen versus Cook. It's a very popularly known case that where a doctor was engaged by a hospital, doctor was staying at a distance from that hospital, and the duties of the doctor was whenever there is a call from the hospital, he had to give instructions, how they should treat the patient till the time he comes to the hospital, and he will travel in the car and come to the hospital. And the hospital used to reimburse him for a part of the total cost which is incurring on the traveling from his home to the hospital. Now, this particular reimbursement was held by the courts. It is not a benefit or a perquisite to him. It's an expenditure which is necessarily required to be incurred for the performance of the duties. for the performance of its duties. So therefore, it does not become his income per se. Now, this, extending this principle, again another, film personality, David Dhawan. Very interesting case. In this, David Dhawan, as you all know, is a very popular director. And in case of film shooting, sometimes in many cases, the film shoot happens outside India, for filming of in Switzerland, filming of the songs, etc. Now, one particular film shoot happened, for 2-3 months at a stretch at a foreign location. There, David Dhawan traveled to that location, and even his family members also traveled along with him. And the producer met the expenses of all, David Dhawan as well as family, family members. And then the issue arose whether the expenditure incurred by the producer in relation to the family members, whether that's a benefit or perquisite in David Dhawan's hands. And the argument which were, presented before the tribunal was that, he is a creative person. All film personalities, actors, etc., are very creative person. They had to do a very long film shoot, away from their home. Now, if they are, away from their family, they may not be in a happy state of mind. Now, taking the family members along will keep them in a happy state of mind, and they will perform their duties very efficiently. So, and for, accepting this argument, the tribunal held that this incurrence of the expenditure by the producer was for the producer's benefit, so that the film is, properly shooted. And it is not a benefit or perquisite per se for David Dhawan. And therefore, it was held that it is not taxable under 28. You may debate, whether this reasoning is proper or not proper, but again, it shows, whether the benefit or a perquisite can be very subjective in many cases. Next, in the last example, which I will take, is of the stock trade. When somewhere there is a taxpayer who is dealing in shares, for shares, is a stock in trade. Now, one particular script underwent a demerger, and he received certain shares of the resulting company. And the tax department tried to say that the shares of the fair value of the shares of the resulting company which he received is a benefit or a perquisite under arising from the business, because the shares were held as stock in trade. These were giving rise to business income. Now he got free shares in lieu of holding of shares of the demerged company. But however, the tribunal held that no, these shares, the shares of the resulting company, are received in consideration of fall in the value of the shares of the demerged company, because demerged company is transferring a unit to the resulting company. In consideration thereof, the resulting company is giving shares to all the shareholders. So therefore, it is these shares, compensate the loss in the value of the demerged company shares, and therefore it is not a benefit or a perquisite. It's a compensatory receipt, and hence 28(4) is not attracted in this case. So you have seen that in many, in so many circumstances, the courts have held that 28(4) is not attracted because either because there is no nexus with business or profession, or there is no benefit or perquisite, or it is of a capital nature in relation to acquisition of capital asset, or discounted purchase is not a benefit or perquisite. So this is all the jurisprudence which is there under 28(4). Before moving on, let's consider certain situations of partner and partnership form. This is also again very interesting. Now, partner and partnership firm, as such, legally they are not two different entities. Partnership firm is a relation between the different partners. Of course, when it comes to LLP, there is a separate identity, legal identity for the LLP. However, for taxation, income tax purposes, LLP is considered as on equal status at par with partnership firm. Now, in certain cases where the partners received certain assets on dissolution or retirement, the tax department tried to tax them as a benefit or perquisite under 28. And the courts, this Gujarat High Court court in Chetnaben Shah or Banyan and Berry, held that this is not arising from the business or profession. Now, partners, it's a relationship between the different partners. Firm is a relationship between the different partners. Basically, all the partners are jointly holding the property. So therefore, when partner withdraws any asset, you cannot say that it has taken from a different person. He may be taking his own asset away. Now there is a separation of the assets which are jointly held. Now each of them is taking away his own asset which properly belongs to him, and therefore it is not a benefit or a perquisite. And you have cases of Supreme Court, many Supreme Court rulings like one by Pamabai, etc., which have explained this concept. And because of which now there are specific provisions in the Income Tax Act. Now, right now, the current provisions are 45(4) and 9(b), which now tax any benefit arising out of the receipt of assets on dissolution or retirement in the hands of the firm and not in the hands of the partner. But that is based on the concept that partner and firm are sort of alternative assessees. Now, before 93, there was a separate scheme for taxation of partnership firm. Income was partially taxed in the hands of the firm and partially in the hands of the partners. So the rates were also different. From 93 onwards, for the purpose of simplification, because that created complications. Suppose there was any addition in the hands of the partnership firm, then correspondingly all the partners' income also changed. So they had to be passed a rectification of the order giving effect to that, the assessment in the hands of the firm. So that created a lot of complications. So from 93, 94 onwards, we have a simplified system where partnership firm is separately assessed and the partners are separately assessed. And the partners are assessed only on certain remuneration within certain limits specified under 40B. So interest, remuneration, bonus, etc., within the limits of 40B, if paid, authorized by deed, etc., it is allowed as a deduction in the hands of the partners and taxed in hands of the firm and taxed in the hands of the partners under 28(5) as a business income. Now, situations may arise, like take for example, that firm has taken a 3-floor premises on rent. Let's say it is paying 3 lakh rupees rental for that property. Out of that, 2 floors are actually used for business purpose of the firm. And 1 floor is used by the partner, one of the partners, for his residence with his family. Now, 3 lakh rupees rental is paid. That is claimed as a business expenditure by the firm. What will happen to that one pro rata portion, 1 floor, 1 lakh rupees, where a partner is enjoying a personal benefit because his family is staying there. Now, in this type of a situation, can the partner say that the firm is in business, he is not carrying on any business, so therefore this benefit is not arising from the business or profession? And the courts have said no, because this firm and partners are alternative assessees. The partner is also carrying on the firm, and the firm is carrying on business. Basically, the partner is carrying on the business of the firm, and this remuneration, etc., is taxed, as as a business income only. So therefore, it cannot be said that the partner is not carrying on any business. The partner is in business. So therefore, that argument is not available. However, if you tax this in the hands, there can be a situation of double taxation. So therefore, what the principle has been laid down by the courts is that the first of the rulings is of Delhi High Court in case of Rajinder Kumar Rajgaria, which is in the 3rd bullet. So what it held is that this 1 lakh rupees, if it is disallowed in the hands of the firm and the firm pays tax on that 1 lakh rupees, then it should not be taxed as perquisite in the hands of the partner. Because if it is taxed, it has given numerical illustration to explain this concept. If it is taxed, again, this 1 lakh rupees is taxed again as a perquisite in the hands of the partner, then both partner and the firm has to pay tax on the same stream of income. And therefore, it will give rise to double taxation. And hence, it should be taxed at only one place. So therefore, if the expenditure is not allowed as a deduction in the hands of the firm, then there is no perquisite in the hands of the partner. As a corollary, if the firm has claimed it as the expenditure as a business deduction, but it is giving rise to a personal benefit, part of that is giving rise to a personal benefit to the partner, then it can be a benefit or perquisite arising from the business or profession in the hands of the partner. So that is the line of decisions. It is there in the 2nd bullet. It is VP Warrior, RL Kasliwal, Premraj Lunawat. Whereas the 3rd bullet is where in the hands of the firm, the expenditure has been disallowed, or in this type of cases, the house property income, the 1 floors, if the property was owned by the firm, then 1 floor's annual value was taxed in the hands of the firm. So this is the principle which has been laid down by these courts. First of the decisions was Delhi High Court. In the MP High Court in VP Warrior's case, did not notice this Delhi High Court ruling in Rajinder Kumar Rajgaria's case. And it plainly said, if the firm's property is used free of cost by the partner, or partner's personal expense is borne by the firm, it results in the perquisite taxation in the hands of the partner under 28(4). However, the next decision, Rajasthan High Court decision in RL Kasliwal, noted both the two decisions, Warriors decision, VP Warriors decision, and the Delhi High Court ruling in case of Rajendra Kumar, and it reconciled in terms of the proposition which is there in the two bullets, that there should not be a double taxation. If the expenditure is allowed in the hands of the partnership firm, then perquisite taxation can arise if that expenditure results in a personal benefit to the partner. However, if the expenditure is not allowed in the hands of the firm, it can be under various forms, like if it is debited to P&L, but it is disallowed in the computation. It is debited as drawings in the capital account of the partners. Then it is not claimed, not allowed as a deduction in the hands of the firm. Then there can be no perquisite taxation in the hands of the partner. I hope this is fairly clear. Next comes the proposition, and this is again a very debatable proposition, is whether in case of B2C transaction, business to consumer transactions, can trigger 28(4). And the thoughts which I am presenting are my personal thoughts, and it is I agree it is very quite sometimes it's very confusing and quite debatable also. But let me try to put up my thoughts why I believe that in case of B2C transactions, in the where it's a final consumer, any benefit given to the final consumer, that should not trigger 28(4) in its hands, even if that final consumer is carrying on business or profession. Now let me refer to the first with 28(4) and 194(r) and the explanatory memorandum. What it says is which are the benefits or perquisites which are taxable or liable to TDS, which are arising from the business or exercise of a profession. So therefore, the source should be the exercise arising from the business or exercise of the profession. So it should be the business or the profession. You refer to the illustration which is given in circular number 20, lawyer receiving rent-free accommodation from the client. So he's rendering professional services, he's getting a personal benefit in lieu of these professional services. So therefore, it is a sort of a B2B transaction, and there it is held to be taxable. Finance Minister's speech talks about benefits which are passed on by businesses to their agents. So it is a B2B transaction that is contemplated to be covered. How the courts have read, I just, in my earlier slides, I just narrated the concept of nexus with business. Now, Bombay High Court in case of Mahindra and Mahindra said, the income which can be taxed under 28(4) must not only be referable to a benefit or perquisite, but it must be arising from business. So, that should be a business nexus, strong business nexus. Then another Bombay High Court in case of, Protos Engineering, where there was a write back of the credit balances of the customers. So there the Bombay High Court said it should have a close and direct nexus with the business of the assessee. These advances were received in the course of business of the assessee, carrying on business with those customers. Now, with these principles, let us consider certain illustrations just to highlight the point which I am trying to make. Let's assume a bank credit card company, as part of the credit card, gives various benefits to its credit card holders. It could be like free airport lounge access, club membership, discount vouchers, gift coupons. The membership fees, let's say, is 45,000 rupees. But the value of all these benefits which are given is, let's say, 80,000 rupees. Now, in case of a salaried employee who is taking this card, you will easily conclude that 28(4) is not triggered because the employee is not carrying on any business or profession. But what if this customer is a proprietor or a partner of a firm carrying on business or profession, and he uses this card for the purpose of his business or profession? Let's say the benefits are used for his personal purpose. So he goes to the club, he goes to the airport. Let's say for lounge access was for his personal trips. Gift coupons he used for his personal benefit. So whether it becomes a benefit or perquisite arising from the business. Now, my argument there would be if he has paid membership fees for that, the question should be any part of the membership fee should be disallowed as a personal expenditure, because what he has got the benefit is a personal benefit if he has used the card for personal purposes. And the expenditure that should be allowed is only which is related to his business or the profession. Now, in this particular case, the credit card facility was availed by him as a consumer, not in a B2B transaction. And therefore, these benefits which he gets, this credit card company is giving these benefits, same benefits to all the customers who pay that membership fees. It may not give the benefits to those people who are not giving those membership fees, or who go and just take 50,000 rupees credit limit. You may not get these benefits. But people who are paying higher fees or agreeing to spend more, they may get these benefits. Okay, so just to take another example, that if you take a domestic air ticket, economy air ticket, you don't get any benefit. You have to travel to your airport on your own. You have to sit outside, no lounge access, etc., and you can travel in the economy class. But let's say take an international airline in a first class ticket. Now the airline may send a chauffeur-driven car to your place to pick you up. You are accommodated at a lounge. You are given food, drinks, etc. Best possible seat. Even if you drop, they may drop you off to your destination. You are given a royal treatment. Why? Because you have paid for a first class ticket. So that is a B2C arrangement. These benefits come along with a price. It is not free, etc. And therefore, this should not. My argument is that, my personal view is that this should not get covered under 28. What may get covered under 28.4? How can it be a B2B transaction? Take the next illustration. Same credit card company, it enters an agreement with a travel agent and says that you can use this credit card for the purpose of booking flights and hotels for your clients. And if you spend so much X amount of rupees for flights or for hotels, we will give you a gold coin, or we will give you a foreign trip, free foreign trip. In that case, there is a business relationship between the travel agent and the credit card company. The credit card is to be used for business purposes. There is a conscious decision or call of the bank to give it for a business use. And then the benefits are given as a sales incentive. So that, I believe, is a B2B arrangement, not the first. In fact, in the first illustration, the credit card agreement will clearly say that the credit card is not to be used for any commercial gain, etc. Not for reselling the products, etc., and making a commercial profit. It has to be used only for your personal consumption. Now, if that is the case, then whether you consume it as an employee of a particular company, or as a sole proprietor, or as a partner, does not make any difference. Take another illustration. We all know when Jio, when it was introduced, it gave free data and voice services for first 6 months to all its customers, all customers. Whether they were in business, they were not in business, everybody got the benefit. Can you say, if this Jio was launched today and giving these free services, can you say that Jio is giving a benefit or a perquisite to those who are in business, but not giving a benefit or perquisite to those who are in employment? But this is also a B2, according to me, this is also a B2C arrangement. It is 28.4 is not meant to be applied over here. Take another example, that if you individually try to go to some Goa and try to book a 5-star hotel room, they may say you have to pay 10,000 rupees per room night and we will give you breakfast, nothing more. But if you are a corporate and you want to organize an offsite and you negotiate with that hotel and say, I want 50 rooms, then it may negotiate, you can have a better bargaining position, and they may agree to give you 50 rooms for 7,500 rupees per night, and they will added facilities. Now it may include lunch, high tea, dinner, plus spa, etc. Everything at 7,500 rupees. Now, can you say that this is a benefit or a perquisite which has arisen from the business of that company? That company may be engaged in manufacturing business, may be engaged in some service business, but it had availed this service for organizing an offsite for its employees. Is it arising from the business? I would argue no. Here the corporate was a consumer, and for 7,500 there was a bargain. There was a price paid for all these facilities. It was a discount, and we'll come to the FAQ4 in the circular where it said that discount is not covered by 194R. So in these type of transactions, I personally believe that 28.4 should not get triggered. Of course, but this is quite debatable. Many of I have heard many professionals taking a other view also. So I leave it up to you to decide, which is a better view. Before we go to 194R, the last aspect, valuation. Now, 28.4 starts with the wording value of any benefit or perquisite. So what is taxable is the value. Now, for value, you need valuation rules. Under section 295 2C, CBDT has the power to notify the rules for valuation of perquisites. Perquisites under any section. So it is not there, it is not said only under 17.2 or something. It's for perquisite for the purpose of any of the provisions of this act. So it can also include this 28.4. However, since 1964 till today, no valuation rules have been prescribed by the CBDT for valuation of any benefit taxable under 28.4 as such. Now, because of this, is it that the courts have said benefit is not taxable at all in absence of the rules? The answer is no. And I have given some examples. In Ram Kripal Tripaঠি's case, the disciples had, accumulated together 16,000 rupees and bought the car. So the taxation was upheld at that 16,000 rupees value. In Priyanka Chopra's case, the FMV of the car and the watch was computed by the AO at a particular figure. Now, the SSC could not rebut that it is at a very high, it is, absurd, etc. And it could not produce any material to show that the fair market value was lower. So therefore, the tribunal said that fair market value has to be accepted. Another decision is of Young Indian. It's a very long, 500 plus pages decision, complicated case law involving political figures, etc. A lot of complications. But the sum, one of the aspect was, the allegation was that the taxpayer received the shares of a company by putting in a nominal amount of 50 lakh rupees. And the shares were of a company which held certain valuable properties. And the property value all put together was in excess of 400 crore. And then that 400 crore less 50 lakhs was, taxed in the hands of this Young Indian by the Delhi tribunal. Of course, there were, there was a lifting of the corporate will by the Delhi High Court in the parallel case, which was then the tribunal had to follow that ruling, etc. A lot of complications. However, the principle was that even in absence of the rule, now there the taxpayer tried to argue that the rule 11 UA, which was existing at that point of time, which had to consider only the net book value, that should be accepted. That argument was also rejected. And the tribunal said that, the value of the properties is the value of the benefit in that particular case. Now today, if you see rule 11 UA, it looks through, for at least for the properties, if you acquire the shares of the company and the company is holding certain immovable properties, then the stamp duty value of that immovable properties are required to be considered. So similar principle was adopted by the Delhi tribunal. In case of this Chennai tribunal in Imbavali, as I said, 4 and 2, the SSC did not give any evidence how much the expenditure was. And the tax officer estimated at 5 lakh rupees. The SSC did not rebut that with any other evidence. And therefore the tribunal said that because in absence of any other evidence, this 5 lakh rupees must be the fair estimate of the expenditure incurred by Onida and Godrej in sponsoring the 4 and 2 and was taxed as a benefit. We have a very classic English case of, House of Lords decision in case of Heaton versus Bell, which has said that normal principle is, because this talks about value of benefit or perquisite convertible into money or not. Now, in this particular case, normally the valuation principle is the value at which the recipient could sell and realize. So if he gets a coat or a suit, okay, so what is the value of that suit for that recipient? You should look at it from the recipient's perspective, not from the provider's perspective. Provider may have incurred 1,000 rupees, but if the recipient can sell it and get only 200, 300 rupees, then for him, the value is 300 rupees. So this is the principle which is laid down in the English case, which has, law, which is a very old decision. But now, if you read Palkewala's commentaries, what it is said is, that is the general principle, but, law can provide otherwise. So now you have Rule 3, which provides the valuation mechanism for different kinds of perquisites in case of salary taxation. So some are at cost to the employer, some are at fair value, etc. So unless there is a specific provision which provides for a value, it is possible for a taxpayer to rely on this old English case law to say the general principle is what he can realize from the sale of that benefit, that unless and until some specific provision comes and overrides this principle. So this is also very useful from a recipient's perspective, and why it is useful, we'll just discuss in some time. So with this background, let's say I consume more than 30-40 minutes just to explain, the scope and ambit of 28.4, and there is a specific reason. Now with this conceptual clarity, now let's get into 194R, how the life changes. So Finance Act 22 introduced 194R. I think some of the basic conditions everybody must be familiar with, but I'll quickly run through it. Which payment is covered, the benefit or perquisite, whether convertible into money or not, arising from business or exercise of profession payable to a resident. So language is virtually picked up from 28.4, but there is no reference of 28. Rate of TDS 10%. It's a domestic TDS, not required to be enhanced by surcharge and cess. Very unfortunately, section 197 has not been amended. So therefore, it is not possible for the recipient to go and obtain a lower TDS certificate or a nil TDS certificate. So the rate of percent will remain 10%. On what amount the tax is to be deducted? It is the value or the aggregate of value exceeding 20,000 rupees during the financial year. Who is required to withhold? Person who is responsible for providing the benefit or purpose, the benefit provider. And that concept is defined in the explanation to 194R. For other TDS provisions, normally you say person responsible for paying, and that is defined in 204. But over here, it is a concept is a person responsible for providing the benefit, and it is defined in the explanation to 194R itself. But the explanation does not take us further. It says simply says it means the person responsible for providing the benefit, and in case of a company, it includes its principal officer. So, which is similar to 204 also. Now, small taxpayers like small businessmen are exempted from this TDS obligation. So, if you are an individual or an HUF where your turnover receipts is less than 1 crore, or if you are in profession and your gross receipts is less than 50 lakhs during the immediately preceding financial year, then you don't have to do TDS. But if your receipts exceed 1 crore in the current financial year, then in the next year you have to do the TDS, whether or not in the next year the turnover exceeds 1 crore. The status of the payee should be a resident. Date of applicability 1st of July 22, so it's already there in force. Timing of the TDS, now here again interesting aspect, it is different from our regular TDS provision. in other TDS provision, the timing is at the time of payment or credit, whichever is earlier. But here it is mentioned, the provider is required to ensure that the tax is deducted before providing the benefit or perquisite. So it is at the time of before providing the benefit or perquisite, you should ensure that the tax is deducted. Now, therefore, there is no concept of credit or credit to suspense account or credit to provision account. That concept is not there. It is at the time when you're actually providing the benefit. What about benefits which are provided in kind? And here there is a proviso, and this proviso to 194R is picked up, literally virtually from the lottery winnings TDS with the 194B. What it says is, if the benefit or perquisite is wholly in kind or partly in cash and partly in kind, but the component of cash component is not sufficient to meet the TDS of the whole of the benefit, then in that case, what is the provider supposed to do? He is supposed to ensure that the tax required to be deducted has been paid before releasing the benefit or the perquisite. So he has to ensure that the tax has been paid before giving the benefit. Yes, sir. Now, how this is to be ensured? The circular is addressing this through FAQ 9. We'll come to that sometime. Last point and important point is the power to issue guidelines to the CBDT. At the bill stage, this power was not there to the CBDT. When we made the representations and brought them various issues, they felt that, okay, they should take the power because a lot of issues, practical issues can be dealt only through a circular. So therefore, as is the trend for the, all the provision, TDS provisions, or even the substantive provisions, which has been coming since last 3 years, they have inserted 194R2 and 3, which says that the CBDT has the power to issue guidelines for the removal of difficulties with the approval of the central government. And these guidelines are to be placed before both the houses of the parliament. And they will be binding on both the tax authorities and the person responsible for providing the benefit. So this is, a little different from circular under 119, which you all know that circulars which are issued under 119, they are binding on the tax authorities, but they are not binding on the taxpayers or the courts. But here, what is provided is that these guidelines, which will be issued through a circular, they have to be placed before both the houses of the parliament, and they will become binding on the tax authorities as well as the taxpayer. So it is not like circular under 119. There is some difference. But how far that difference is relevant and significant, we will debate that in some time. Next, certain aspects of this TDS. If the recipient does not have a PAN, we all know that the rate of TDS has to be increased to 20%. Also, if the recipient has not filed his returns for the last year, then you have this functionality, compliance check functionality. You have to check, and if he is a non-return filer, he has not filed his returns, and the cumulative TDS is more, TDS and TCS is more than 50,000 rupees, then the rate of TDS will increase to 20%. Next is the disallowance of the, what if the expenditure itself is not allowable in the hands of the provider? And the classic example is this freebies which are given to the doctors, which are prohibited by the MCI guidelines. Now, in that case, you have explanation 3, which has been added recently by the Finance Act 2022. You also have the Supreme Court ruling in case of Apex Laboratories, which held that if the benefits or if the freebies are prohibited for the doctors from receiving them, then they are equally prohibited for the pharma companies from paying it. And therefore, it will be disallowed in the hands of the pharma companies. So, the prohibited, or which is an offense or prohibited by law, means even if for the payee it is prohibited for the payer also. And that has been codified into explanation 3, the second clause, by the Finance Act 2022. Now here, so therefore, if the pharma companies are giving any freebies to the doctors, which are in violation of MCI guidelines, they will have a TDS obligation under 194R, even though they cannot claim the expenditure as a deduction in their business income computation. In other cases where these are not prohibited, or these are otherwise allowable, if the TDS is not done, then we all know 40A1A provides for disallowance. But how will this operate in this particular case, 194R? Take a case, the benefit is given by purchasing the gold coins. So the manufacturer purchases the gold coins from the jeweler and gives it as a perquisite or a benefit as a sales incentive to the dealer or the distributor. Now, in this case, while purchasing the gold coin, it has to do TDS under 194Q on purchase of goods. When it has to giving the benefit to the dealers, it has to now do 194R. Suppose at one of the stage, there is a default, or at both the stages there is a default. How much disallowance should be there? I personally believe that it should be only one disallowance of 30%, because you are claiming the expenditure on the gold coins as a deduction. So let's say it is 1 lakh rupees, you are claiming it as a deduction in your P&L account. 30% of that, only 30,000 can be disallowed. If you fail to do any of the TDS, either if you don't do TDS on purchase of 194Q, that can be disallowed, 30,000. If you do under default under 194R, you do 194Q, but you don't do 194R, then also 30%, 30,000 will be disallowed. It cannot be, because if you fail to do both 194Q as 194R, it cannot be 60,000. That is my personal view. Of course, this is quite debatable in that sense, and we may have litigation on this issue. Next is, if there is a TDS default, it needs to be required to be reported in the tax audit. So you have clauses 21B2 and 34, where the tax auditor will have to verify the compliance with TDS provisions. And now, because of this new addition of 194R, it will have to check the compliance for 194R also. If there is a TDS default, are there any other mitigation measures? Yes, there is. You have first proviso under 201, where if the recipient who received the payment without TDS, he has to give a CA certificate in Form 26A to the deductor, to the payer. In that case, what will happen? According to the first proviso to section 2011, no recovery of the principal amount of TDS will happen from the payer. So therefore, he will not be regarded as SSC in default with regard to the tax amount. Second is, he will be liable to interest, but the interest meter will stop on the date of filing of return of income by the recipient. So in 26A, he has to give what is the date of filing of the return, whether this income has been taken into account, etc. So the interest will be leviable only till the date of filing of return by the recipient. Third is, if the amount has been disallowed in the hands of the payer in year 1, it will be allowed as a deduction. Say 30% expense is disallowed in year 1. It will be allowed as a deduction in the year of filing of return by the recipient. So we'll get the amount, the disallowance, he will get it as a deduction in the second year. But here, there is a practical challenge in case of benefit under 194R. Now, normally these benefits, nobody, earlier the practice was nobody used to offer it in the return of income. And if you see the conditions of 201, there are 3 conditions. That the payee should have filed the return. Second is, the payee should have taken into account this sum in his return of income. And the third is that he should have paid tax due on the return declared income. Now, taken into the second condition, taken into account. Now, taken into account means what? Suppose it is taxable, he should have offered it to tax. Suppose it is like not taxable, like, it is a reimbursement of expense, he should have reduced it from that particular cost. Or sometimes it is like the advance received, so he would have shown it in the balance sheet, etc. But he has considered that amount in his return of income. But in this particular case, suppose a gold coin is given and no tax is deducted, and he does not show it anywhere in the return, whether that condition can be taken to be fulfilled is very doubtful. And therefore, whether this compliance can be done, taken into account condition is fulfilled or not, can be little doubtful and debatable. Next is the overlap with existing TDS provisions. Now, you may provide certain in-kind benefits to your contractors, consultants, professionals, or independent or non-executive directors, etc., which are otherwise covered by 194C, 194J, 194H, etc. These are the regular TDS provisions. Now, is it possible to argue that those provisions only cover monetary payments and non-monetary payments are not covered? My personal view is no. These provisions talk about any sum. And in case of 195 also talks, section 195 also talks about sum chargeable to tax, where Supreme Court has held in case of Kanchanjunga Seafoods that it also covers payment in kind. The Karnataka High Court ruling was very expressly stated that it can cover payment in kind. So therefore, if you give ESOPs to your non-executive directors, your independent directors, it will come under 194G. So if you give any in-kind benefit, that was what I was talking about in the first slide and the second slide, that today, if you are giving any rental accommodation to your lawyer as a professional fee, in consideration of professional fee, my personal view is that it is covered by 194G. So if it is already covered by some existing TDS provision, now whether it will come under 194R, now here we can refer to circular number 720 of 30th August 1995, which has clarified that all TDS provisions are mutually exclusive. TDS can happen only under one section. Not, double TDS cannot happen. Simultaneous TDS under two provisions is not envisaged. So therefore, each TDS specific provision is mutually exclusive. It will include, if your payment is covered by one TDS provision, it will not be covered under any other provision. But let me clarify the example which you had taken in the earlier slide, purchase of gold coins and giving it to your dealers. I would say that there are two transactions. You have purchased the gold coin, that is one transaction. You could have kept it for yourself. You could have, just kept it, not given to anybody. You could not have given to your dealers. You could have given it to an employee. It was up to you. You chose it to give to the distributors or dealers. That is a second transaction. And therefore, if, there will be two TDS in that. So, no, that distinction we have to bear in mind. So, the purchase transaction is covered by 194Q and the providing of the benefit is covered by 194R. Now, there is also a Delhi High Court ruling in case of Prasar Bharati, which has said that if there is an overlap, let's say between 194C and 194J, the specific provision will override the general provision. And there it was concerned with the broadcasting, payments for the broadcasting, etc. So they said that 194C already covers broadcasting. So therefore, it's a specific provision. In that case, the court held that both 194C and J were brought in together. And therefore, the more specific of the two will apply. I believe the specific override general is a general proposition. So wherever there is a conflict between two TDS provisions, one should always look out what is the more specific provision to that particular transaction. In case of professionals or consultant fees for technical services, contractors, etc., I would say 194C or 194J is more specific provision, which will override 194R. Of course, if you are talking about professionals where the TDS rate is 10%, it is academic, whether you do under 194J versus 194R. If it is a lower TDS rate provision, then the conflict can arise, like 194C at 2%, or under 194J FTS at 2%, or commission at 5%. This can conflict with 10% under 194R. Now, after the section was enacted, but before the guidelines were issued, the industry made representations. And various issues were presented to the CBDT to issue clarifications. So 4 or 5 main themes were there. First of all, it was represented that, for TDS purposes, TDS is on the value. unless the CBDT prescribes the value, it will be difficult for the people to do TDS. So therefore, and 295 2C gives power to the CBDT. So the CBDT should come out with the valuation rules. The next is a distinction between bona fide business expense and a personal benefit. And certain examples were given that, certain expenses are incurred not for the purpose of giving benefit to the dealers, distributors, like conference. It is for the purpose of educating them or discussing the business strategy, new products, etc. Predominantly, everything is official business discussion, etc. But there could be certain incidental leisure activity. Like if the conference is spread over 2 days, for the first night, there could be some gala night, networking dinner, cocktails, etc. It should not be considered as a benefit or perquisite. That was the ask of the industry. Next example was given that, if the printer, like a print company which sells cartridges and also manufacture printers, like let's say HP, they give the printer free, but with the condition that all the cartridges have to be, bought from the same company. Then there is a business motive behind that. It is not given free. It is not given as a benefit, but because the company expects to earn from the sale of the cartridges. And therefore, the printer which is given free should not be considered as a benefit or a perquisite. That was the ask made to the CBDT. Third is free medical samples. Here, reliance was placed on Supreme Court ruling in case of SKF, which held that free medical samples are, whether it is of a new medicine or an established medicine, is given for the purpose of sales promotion and publicity, advertisement and publicity. Now, this had a specific connotation under the old section 37, where you had certain, artificial disallowance provisions. So it is meant for advertisement and publicity. So it is not meant for the benefit, giving benefit to the doctors. It is meant for advertising and publicity of the goods or the medicines which the pharma companies are producing. Next is these discounts, rebates, credit card loyalty points. Here, reference was drawn to the circular issued under FBT, Fringe Benefit Tax, which was there from 2005 to 2009, where the employer or the company had to pay FBT on a specified percentage of the various expenses, hitting its P&L account. Now, there it was clarified that discounts, rebate, credit card loyalty points, etc., are an ordinary selling expenditure representing lesser realization of a sales price, and therefore it is not in the nature of the sales promotion, etc., which was otherwise liable to FBT. So they were clarified to be outside the scope of FBT. The next aspect which was highlighted was the issue of double taxation. Let's take this printer, same printer example. Printer is given free to the customer. Customer uses it as his capital asset in his business. Now, it cannot capitalize it because it has incurred no cost on it. So it does not get any depreciation allowance. Therefore, its business income is already higher to that extent. Now, if a TDS is done on this printer, what will happen? Some income will get added in the hands of that particular customer. And if the customer is not granted depreciation allowance, then there will be a double taxation. Right? Second example was given in interest-free loan. That one company, as we just saw, the Salgaokar's decision, etc. Parent gives interest-free loan to a subsidiary. In that case, if subsidiary's income is already higher because interest cost is not debited to its P&L, even if it is debited because of Ind AS, etc., it's all notional adjustment. These are added back in the part of the computation of income. So there is no interest expenditure. So its income is already higher to that extent. But if you consider separately this as a benefit or a perquisite, then there will be a double taxation. Therefore, an artificial income will be added again. To neutralize that, a corresponding deduction has to be given of the interest expenditure because the funds are also used for the business purpose of the subsidiary. If that is not done, then there will be a double taxation. Another aspect was that certain benefits can be used only by the individuals. So, for example, you give a foreign trip, you give the gold coins, etc. Even if the distributor or dealer distributor is a company, that will be consumed by some individual who could be the owner, employee, director, partner, etc. So, in whose name the TDS should be made? In the names of the recipient entity or in the names of the individuals? So that was again aspect which was represented to CBDT to be clarified. And lastly, if there is a difference of opinion between the payer and the payee, normally when you are concerned with payer TDS, the payer always prefers to follow a safe mode, okay, to err on the safer side. So he prefers to follow a conservative approach. So he may deduct the TDS, but the payee may feel that, no, this is not my benefit or perquisite. So if he doesn't offer that to tax, can he claim the TDS credit or not? Or whether it will be added in his income while doing 143(1), etc. What certain of the difficulties which were highlighted to the CBDT for appropriate clarification in the matter. The CBDT responded with circular number 12 of 2022, and it has addressed all these difficulties by way of 10 FAQs. And we'll quickly go through these FAQs in the next 4 or 5 slides, and then we go to each of the FAQs and discuss what are the challenges or what are the implications of each of these FAQs. So first FAQ, the question which the CBDT sought to answer is it necessary that a person providing the benefit or perquisite needs to check if the amount is taxable under 28(4) before deducting tax under section 194R? And the answer given in this FAQ is that no, the payer is not required to check whether it is chargeable to tax under 28(4). It can be taxable under 41(1) or any other section. In fact, the payer is not even required to see whether it is chargeable to tax or not. And a distinction has been drawn between this TDS versus 195, where it concerns payment to non-residents, where the language uses some chargeable to tax, where the payer is supposed to look at the taxability in the hands of the non-resident payee, plus availability of the treaty benefit and the TDS rate under the treaty. If the TDS rate under the treaty is lower, he can give the benefit of the treaty. Now, FAQ is saying this is different. The language of 194R is different. The sum chargeable to tax and the rates in force is not there. These two terms are not used in 194R. So the payer is not supposed to verify the taxability at all. This is similar to what they are trying to say. This is similar to the ratio of the Supreme Court ruling in case of PILCOM, where Supreme Court was concerned with payment to non-resident sportsmen, which is covered by 194E, which provides for a specific rate of 20%. And the Supreme Court held that since it provides for a 20% treaty rate, TDS rate, the payer cannot consider the treaty benefit. The payee has to file the return and claim the treaty benefit. Now, same language was there in 196D. 196D applies to payments to the foreign portfolio investors, FIIs. So there, Finance Act 2020, brought back the classical system of dividend taxation, and therefore the TDS rate for the foreign portfolio investors became 20% under 196D. Whereas under the treaty, if they are coming from a treaty country, the rates would have been lower. So therefore, 196D was later on amended by Finance Act 2021 to provide that if the FPI is coming from a treaty country and is entitled to treaty benefit, then the tax can be deducted at the treaty rate. So the example is given of 196D and PILCOM ratio, which says that otherwise, if it does not admit of a treaty benefit, so it requires you to do 10%, you don't need to check whether it is taxable or not taxable. The second example, now, of course, the first immediate question that arises is there, does it not conflict with the express language of 194R? The intent was explained in the explanatory memorandum. What the finance minister said in her speech, a business is giving benefit to their agents, 28(4), to people not offering their taxes, etc. Is there not a conflict? Okay, we will discuss that in greater detail a little later. FAQ 2 talks about the proviso, proviso and the monetary benefit. The question is it necessary that the benefit or perquisite must be in kind for section 194 IR of the Act to operate? And the answer given is no. It need not be in kind. It can, even monetary benefits are included because, and it relies on the proviso, because the proviso, it has reproduced a proviso, and then it says that the proviso clearly indicates the intent of the legislature that there could also be situations where benefit or perquisite is in cash, or the benefit or perquisite is in kind, or partly in cash and partly in kind, and therefore 194R includes even monetary payments. Now here the proviso is not there in 28(4) because 28(4) is only the charging section, the income computation section. Proviso is there in the TDS provision. So, but the main section of 194R is identical to 28(4). Now, therefore, one could have taken a view that based on Mahindra and Mahindra ruling, which we discussed during the initial part, that 28(4) covers only monetary, non-monetary payments. Therefore, 194R would have also applied only to the payments in kind. Now, because this proviso, the CBDT is interpreting as if because of the proviso, the main section undergoes a change, and the main section now includes cash payments also. Is this the correct interpretation of the first proviso is a matter of debate. Next is third question. What if the benefit is received in the form of a capital asset, whether 194R will apply? Now there the answer given is yes, 194R can apply even to a benefit received in the form of a capital asset. Now this principle is correct, that even if you under 28.4 we have seen the example, Priyanka Chopra receiving car, watch, etc., gift of car which is received from the disciples, etc., etc. You can receive a benefit which you may then use as a capital asset for your personal use or for your business use, but it should arise from the exercise of your business, and it should not be a benefit receiving acquisition in the the benefit which is received in the course of acquisition of capital asset. So the distinction that we have seen between Priyanka Chopra receiving the car as a brand ambassador versus Indigo receiving the credit note from the aircraft manufacturer in the course of acquisition of an aircraft, there is a distinction between the two. The first one is covered by 28.4, the second one is not covered by 28.4. Now it has given certain examples, these decisions to illustrate this point. Now out of that, one decision is clearly supports this principle, which is the Allahabad High Court in case of Ram Kripal Tripathi. Other decisions create a lot of confusion, and we'll come to that in some time. Next is FAQ 4, very important, divided into 9 paragraphs. Now, first aspect which is clarifying in the 194 in that FAQ 4 is that sales discount, cash discount, and rebates, whether they are benefits or perquisites. And what is clarified is yes, these are also benefits, but if by doing TDS under 194R for these type of benefits will create difficulty for the seller, and therefore to remove difficulty, it is clarified that TDS is not required. TDS under 194R is not required for sales discount, cash discount, or rebates. Now, these discounts could be financial or it could be quantitative in nature. The third paragraph gives the example that if you are giving 10 items and then you give 2 items free, then it is a quantitative discount, and therefore it is not covered by 194R. You don't need to do TDS on those 2 items which are given free. And the principle which is explained for this clarification is that these represent a lesser realization of the sale price for the seller, and to that extent there is a reduction in the purchase price for the purchase for the customer. And because of this clarification is given, no TDS to be done on these 3 items. But then the 4th paragraph and goes on to explain, and even the 3rd paragraph at the last sentence explains that this clarification will not apply to free samples. This clarification will not apply to incentives other than discount or rebate, cash in the form of cash or in kind, such as car, TV, computer, gold coin, mobile phone, or a sponsored trip, or a free ticket for an event, or free medicine samples. This clarification will not apply. In these cases, TDS under section 194R will apply. And it's also further clarified in the 5th paragraph that the above examples are only illustrative, and the relaxation which is provided from non-deduction of tax for sales discount and rebate is only on those items and should not be extended to other items. So it is abundantly clarified that the relaxation is limited only to these 3 items: sales discount, cash discount, and rebate. Next is the practical difficulty which was highlighted, that these benefits are consumed by the individuals, not by the entity like the distributor or the dealer, which could be a company. So for that, the practical solution which is provided is that the provider should do the TDS in the name of the recipient entity, and then the recipient entity can then decide whether to do further TDS in the name of that individual as a salary, or as a, if the other person is a consultant, then TDS under 194R. So this is a practical solution of a dual TDS which is provided in paragraph 6. However, the example which is given there creates a problem. The example which is given is there of free medical samples, and the example what it says is that if the free medical samples are given to the hospital or given to the doctors in a hospital, then the TDS should be done under 194R, should be done in the name of the hospital. Then if the doctors are employees, then the hospital can do a further TDS as a salary, and as a salary TDS in their name, and can claim the TDS amount which is done as a TDS under 194R by the pharma company as an expenditure in the nature of salary. Similarly, if the doctors are consultants, who receive the free samples are consultants, then the hospital will have to do a TDS under 194R in the name of the consultants. Paragraph 8 gives a further alternative option, saying that if the doctors, if these pre-samples are given to the consultant doctors in the hospital, then the pharma company can, instead of doing TDS in the name of the hospital, can directly do TDS in the name of the consultant also. Because, doing TDS, instead of doing 2 times 194R in the name of the hospital and in the hospital in the name of the consultant, directly, because the consultant is the, according to the CBDT, the consultant doctor is the ultimate beneficiary, and therefore you can do directly in the name of the consultant itself. The last paragraph, paragraph 9 says that, if this TDS is not required to be done, if this benefit, etc., is given to the government entity, which are not carrying on business like government hospital. Now, government, as we all know, is protected from TDS, whether it is carrying on business or not carrying on business. There is a section 196 clearly says no TDS is required to be made when the payments are made to the government. But the important principle is whether this principle, because the government is not carrying on business and therefore TDS is not required, can be extended to other entities which are not carrying on business, just like charities. So that could be quite interesting, and we'll have to look at situations, because charities can also be carrying on certain business. And, like, for example, if they are running a hospital, the big names in the Bombay who are running hospitals, they are all run by charities, but it's carried on as a business activity, but the profits are flowed back into the charity. So they are carrying on business, but the profits are also used for charitable purposes. So if they're carrying on business, then, this principle may not apply. But the charity is not carrying on business, then whether this analogy or principle can be applied. The next is the fair market, the valuation. Because valuation rules are not prescribed, so therefore there had to be a guidance on what value the TDS has to be deducted. So FAQ 5 addresses that. It says the first general rule is the value would be based on the fair market value of the benefit or the perquisite, subject to 2 exceptions. One is that if the benefit or perquisite provider has purchased the benefit or perquisite before providing it to the recipient, then in that case, the purchase price shall be the value for such benefit or perquisite. So to take an example, if the gold coins are purchased for like 10 lakh rupees and then they are given to the distributors, then 10 lakh rupees is the value of the benefit. Similarly, if a car is given or computer is given, mobiles are given, so you take this. Now, I would believe that in this case, it can be reasonably extended even to services, because purchase the benefit of the perquisite. I would read it in a because it is for removing of difficulties. I would not read it in a very literal and a technical sense. I would read it a little more pragmatically, to say that if you have purchased services, for example, for foreign tour, you go and buy a foreign tour package from a tour operator. Then you may have paid 5 lakh rupees, and that voucher is taken in the name of the dealer or distributor in order to give him a benefit of the foreign tour. So then that purchase price should be taken as the value of the benefit. Just like, I go back to that Madras High Court ruling, Madras Tribunal ruling in case of Imbavali, where Onida and Godrej had sponsored the foreign trip of the taxpayer, and that expenses were also estimated around 5 lakh rupees. So the estimate there was made on the basis of expenditure incurred by the benefit provider. The second exception is the benefit or the perquisite provider manufactures such items given as benefit or perquisite, then the price that it charges to its customers for such items shall be the value of for such benefit or perquisite. So what it says is, if it is a captive benefit manufactured by themselves, manufactured by the provider itself, like for example, it's an automobile company which is manufacturing cars and selling the cars, and it gives car as a benefit to one of the dealers, distributor, or somebody, then the price at which the manufacturer sells to its customers. Now, its customer would be the immediate customer is the distributor, not the final customer. So therefore, that price is to be taken as the perquisite value for the purpose of TDS. Lastly, it is also clarified that in case of GST, GST, because GST will be levied on such items, that GST is to be not included for the purpose of valuation of benefit or perquisite for TDS under 194R. And the rationale would logically be, because if the company has purchased any benefit by paying GST, that GST it can claim as an input tax credit, and therefore that should not enter the valuation. However, this rationale is not explicitly clarified in the clarification. It simply says, without any qualification, that GST will not be included. So therefore, it is possible to take a view that even if ITC is not available, input tax credit is not available, still the GST can be excluded, which will put at par with any other TDS provision as we have seen, TDS on purchases or TDS on professional fees, rent, etc., where it is already clarified that the GST is to be excluded for TDS purposes. Now, the basic principle which is coming out from FAQ 5, the base valuation rule is fair market value. But fair market value is not defined. It is not defined in the circular. In the Act, it is defined in section 222B, but the definition is there only for a capital asset. And what it says is the fair market value is the price which a capital asset would fetch in the open market. And if such price is not determinable, then the fair market value will be determined as per rules to be prescribed. But so far, no rules have been prescribed in this particular situation. So again, fair market value concept would be little subjective concept. FAQ 6, social media influencer. You give products, the question says many a times a social media influencer is given a product of a manufacturing company so that he can use the product and make audio video to speak about that product in social media. So is this product given to influencer a benefit or perquisite? So there it starts with the principle that whether there is a benefit or perquisite will depend upon facts of the case. Now, this is a very important clarification, and I believe this should have come in FAQ 1 at the start itself, that whether there is a benefit or perquisite, you need to look at the facts of the case and then decide whether there is a benefit of perquisite arising from the business or profession, and then you determine, if there is a TDS obligation or not. But it is there in FAQ 6, one can always rely on it. Then it goes on to say that in case the social media influencer is allowed to retain these goods for himself, he is not required to return the goods, then there is a benefit and TDS has to be applied. But if these goods are supposed to be returned and taken back from him, then no TDS is required. If they are returned after use, like products like car, mobile, outfit, cosmetics, etc., if they are returned after use, then no TDS is required. Now, this illustration takes into account a social media influencer. So immediate questions which can come in the mind are whether this principle can be extended to other similar cases in the industry. What if it's an item is allowed to be used till the end of its economic life? It is not immediately returned, but it's kept for a long period. Then fair market value or TDS has to be seen at what point of time? At the time of giving the product, or at the time when you take a decision that, okay, he can keep the asset and he did not return it back. So these are the immediate questions which will arise. Of course, we'll discuss it in little detail later. Next is again a very business, a very important business transaction of reimbursement of expenses. So FAQ 7 deals with reimbursement of expenses. So what the principle it tries to clarify is that if any expenditure which is the liability of a person who carrying out a business or profession, if it is met by the other person, then in effect it is a benefit or perquisite provided by the second person to the first person, and therefore it is a benefit or perquisite which will come under 194R. And then it gives the example of a consultant who incurs traveling expenses for the purpose of rendering services to the client, and he gets a reimbursement from the client. Now he can, for the professional fees which he received, against that he can claim these traveling expenses as a deduction. So therefore, if the client reimburses the traveling expenses, it says that it is a benefit or a perquisite. Of course, you can debate whether this is correct or not, but then it goes on further to say that in case the invoice for the travel or the hotel, etc., is in the name of the service provider, which is the consultant, then it is his expense. And if it is paid directly or reimbursed to the consultant by the client, it's a benefit or perquisite on which TDS under 194R will apply. But if the underlying invoice is in the name of the client, let's say the hotel expense, the hotel invoice is in the name of the client, and it is initially paid by the consultant and then reimbursed by the client or paid directly by the client, what FAQ 7 says is that then it is an expense of the client, not an expense of the service provider or the consultant, and therefore no TDS is required to be done. Now, based on our discussion with CBDT official, perhaps the logic which they have applied is that if the invoices are in the name of the service provider, the consultant in this particular case, they can claim an input tax credit as their own expense. And therefore, if these expenses are reimbursed by the client, it is an expense made by other person, and therefore it's a benefit or perquisite. is the, that is the logic for this FAQ. Now this throws up the base questions. We have seen Owen versus Pook and other decision making. Expenses which are required to be incurred for the purpose of rendering services, if they are reimbursed, how can it be a benefit or a perquisite? Now, does this not overlap with FAQ 30 of Circular 715, where it has been clarified that 194C and 194J will include reimbursement of expenses to the contractor or to the professional? So therefore, in that case, is that not overlapping with this FAQ 30? And there will be huge practical challenges to avoid this TDS by taking invoices in the name of the client. It may not be possible in all the cases. So we'll discuss on the other issues in a little while. Next FAQ 8. Business conferences. Now there FAQ 8 says that, first paragraph, it is divided into 3 paragraphs. So first paragraph says that if the conference is held with, dealer business conference is held with the prime object of educating the dealers or the customers on several aspects, and 6 aspects has been given, like product launch, product related information, queries, resolving queries, reconciliation, etc., all business related, then there is no benefit or perquisite. But the second para goes on to say that, however, such conference must not be in the nature of incentives, benefits to select dealers or customers who have achieved particular targets. In that case, there can be 2 ways of interpreting. What it says is, such conference must not be in the nature of incentive benefits to select customer dealers who have achieved particular targets. So one way how the taxpayer may try to interpret is that if I have given a scheme whereby I'm saying if people who meet the sales target, I will take them to a foreign location and it is for a leisure trip, then it is in the nature of incentive benefit to the select dealers or customers who have achieved targets. And therefore, this second paragraph will cover only the leisure trips given to the select dealers or customers. That is one way somebody can interpret. But of course, the tax authority, and based on our discussions, that is how they interpret is that no, in such case, if you are inviting only select dealers and you have selected those dealers based on their achievement of performance targets, then the entire conference expenditure is a benefit or perquisite to them, notwithstanding the fact that this conference ultimately, you are covering only the aspects which are covered in first paragraph, educating the dealers about the different products, etc. And there is no other leisure element involved. Still, the entire conference expenditure will be taken as a benefit or perquisite, which is a very radical interpretation. The third paragraph goes on to say that certain components are leisure personal components and therefore they will be liable to TDS. For example, the expenditure attributable to the leisure trip or leisure component, even if it is incidental, or accompanying family members, or before the conference date, the stay prior to conference date, or the stay after the conference date. So these are leisure components, personal benefits, and these will be liable to TDS. Excuse me. We will debate. There will be practical challenges in how to identify this leisure component and how to identify these expenses for these, family members, etc. Next is FAQ 9, where it says, the example, the first proviso, where it says that if the payment is made in kind or partly in kind and partly in cash, where cash is insufficient, that time the provider has to ensure that the tax is paid. So how does he ensure that? So FAQ 9 provides a good solution, practical solution, that you take a declaration from the recipient that he has paid the advance tax, and this advance tax includes the value of the TDS amount which is otherwise required to be deducted, and and then you report this challan number, etc., in the form 26 QB, which is the quarterly TDS return of the provider. And this year's form 26 QB has been amended to capture these details, challan number of the advance tax challan of the recipient, etc. So therefore, that is a solution which is offered. It's a very good solution. But however, this next para goes on to the second para says that as an option to remove difficulty, the benefit provider may deduct the tax. So you may deduct the tax also and pay to the government. But a tax should be deducted after taking into account the fact that a tax paid by him as TDS is also a benefit under Section 194R. So therefore, if you are deducting tax, then you should do it at a appropriate gross up. It's a net of tax arrangement, is what the clarification says. Now it's a matter for interpretation whether it is applies only in a case where the tax is borne by the payer, or it applies also in a case where tax is not borne by the payer, but it is recovered from the payee. So we will debate that in a little while. Then the manner of how the grossing up is to be done, that also we will discuss. The last FAQ is that what happens to the transitional year 2022-23. This provision has come into effect from 1st of July 22. So what happens to the benefits of perquisites which have been provided from April to June, especially for computing the threshold of 20,000 rupees. And what this FAQ says, very logical and reasonable clarification, that for computing the 20,000 threshold, you have to take into account these benefits, because the 20,000 threshold is for the entire financial year. So therefore, you have to consider these benefits which are provided in the first 3 months. If the threshold has already been closed, then from 1st of July 22, from rupee 1, you have to start deducting tax. But TDS will apply only on the benefits which are perquisites which are provided on or after 1st July 22. So if you have given more than 20,000 benefits in the first 3 months from April to June, then you are not required to do a retrospective TDS of that. TDS has to be done only on the benefits which are provided on or after 1st of July 22. So these are the 10 FAQs. Of course, it raises a lot of controversies, etc. So let us, one of the issues which will come is, in many ways, it is trying to exceed what 194R is saying. So it is creating conflict with 194R. So can it be challenged in a rate, whether it is ultra virus section 194R, can the taxpayers do so, especially when we read FAQ 1, FAQ 2, FAQ, the free about the free samples, FAQ 4 about free samples, etc. Now there, if you look to the past Supreme Court rulings, what are the boundaries or the fetters on the government when they are exercising the power to remove the difficulties? So you have two cases, Straw Products and Madhav Upendra Sinha of Supreme Court. Now both the cases have almost a similar fact pattern. So way back, if you see, when India got freedom, there were princely states. Princely, because of the efforts of Sardar Vallabhbhai Patel and all, these princely states merged into the Indian Union. Now for income tax, so therefore the Indian income tax 1922 was extended to even those princely states. Now because of this extension, it could have created certain transitional difficulties. So for example, computation of the written down value of the assets. For these purposes, the Extension Act gave powers to the government to remove the difficulties by issuing rules, by notifying the rules in the official gazette. So one of these rules said, what it said, while for computing the WDV of any depreciable asset, the depreciation, if it has been allowed under the local income tax law of the principal state, that has to be considered. Even if it has not been allowed for some reason, because the income is exempt for any other reason, whatever the depreciation that taxpayer would have got under the Indian Income Tax Act, that has to be notionally reduced, not notionally allowed. So let's say the actual cost is 100 rupees. Okay, and if the SSC was under the Indian Income Tax Act 1922, he would have got depreciation of 40 rupees up to the date of the merger into the Indian state. Then even if he has not got 40 rupees depreciation as per the income tax laws of that local state, still for Indian Income Tax Act purposes, this 40 rupees will be considered as actually allowed, and WDV will be taken at 60 rupees. That is what this, the rule said, what the government notified them. This was challenged before the Supreme Court. And the Supreme Court held, in the first case, Straw Products, that the power to remove the difficulty is the difficulty which arises in the application of the Income Tax Act to the merged states. It can be exercised in the manner consistent with the scheme and essential provisions of the Act and for the purpose for which it is conferred. Under the Act, Income Tax Act, the WDV is actual cost less depreciation actually allowed. So there cannot be, you cannot consider depreciation which is notionally allowed. So this 40 rupees, you cannot reduce it under the guise of exercise of the removal of power of difficulties. This power is not given to you to change the structure of the Income Tax Act. This case was decided in 1968. Similar thing happened again in 1961 when Goa, the three, Goa, Daman and Diu, they were freed from Portuguese rule and they became part of the Indian Union as a union territory. Similarly, the Indian Income Tax Act was extended to these three union territories. Similar provision was, the removal of power was given for removal of difficulties. Again, the same rule was again notified by, the government because, based on past experience of 1948-49. So even here, the same ratio, the same decision was given by Supreme Court by following the straw products in case of Madhave Sinai by saying that this power, the difficulty contemplated by the clause must be difficulty arising in giving effect to the provisions of the Act and not a difficulty arising aliunde or an extraneous difficulty. The central government can exercise the power under the clause only to the extent it is necessary for applying or giving effect to the Act and no further. It may slightly tinker with the Act to round off any angularities or smoothen the joints or remove minor obscurities to make it workable. But it cannot change, disfigure or do violence to the basic structure and primary features of the Act. In no case can it, under the guise of removing a difficulty, change the scheme and essential provisions of the Act. So therefore, it cannot go against the basic structure of the Act. It has to conform to the basic structure of the Act. It can remove certain minor difficulties, minor obscurities and make it workable. But it cannot, like for example, in that actually, you cannot say when the Act says what has to be reduced is a depreciation actually allowed, you cannot reduce depreciation, a notional depreciation allowance. This is what the court said. Now, here also taxpayer can consider, if he wants to file a writ against 194R, against this circular, not against 194R, though there is a distinction. Now, taxpayer will, 194R, I don't think we can challenge it constitutionally because it was brought in to cover a specific provision, specific benefits which are not getting captured for tax purposes. Here, the circular is going, exceeding, according to the taxpayer, the circular is exceeding the brief given by 194R. And therefore, the taxpayer will have to argue that here the circular is changing the scheme of 194R, changing the basic scheme of the Act. So the challenge will be to the exercise of the delegated legislation and not to the basic provision of the Act itself. The next point in the challenge will be that this is not a circular issued under 190. It is issued under the power of removal of difficulties, and this circular will be placed before both the houses of the parliament. And it is specifically provided that it will be binding on the tax authority and the person providing the benefit. So does it get the status of a law? And therefore, it will be immune from a challenge in a writ. And these two Supreme Court decisions, which are on the slide before you, they say no. This is still a delegated legislation. They have to conform to the basic statutory provisions, and merely because they are placed before the parliament does not give it the status of a law enacted by the parliament, which is passed by both the houses and there is a presidential assent. That procedure is not followed for this rule. So it is not a law per se. It is still a delegated legislation, and therefore it can be challenged as being ultra vires to the section. So here, we have defined that, if the taxpayer has to challenge, he has to show that it is against the basic scheme and structure of 194R, whereas the tax authority will say, no, it is conforming to the basic structure and, of the 194R, and it is just removing certain difficulties. So that will be very interesting if any taxpayers or any association files a writ against this 194R, how the courts will interpret the circular. Now, in this background, now in the last stretch, around half an hour stretch, I will now discuss some of the specific issues which is arising from each of the FAQs. Now, FAQ 1, as we saw, it clarified that the payer does not have to check whether benefit or perquisite is taxable or not. It has to simply tax it. Benefit may be taxable under 28.4, it could be taxable under 41. And then Pilcom ratio, and it has given the distinction between 195-1. Now, despite all this clarification, what the taxpayer can argue is that what are the main conditions required to be fulfilled? The twin conditions are that there should be a benefit or perquisite, and it should have a nexus with business or profession, arising from business or exercise of a profession, and whether convertible into money or not. These are basic conditions. These cannot be diluted by the circular. So therefore, unless these conditions are fulfilled, TDS under 194R cannot apply. For this, taxpayer can also take support from Supreme Court ruling in case of Arun Kumar. There it was concerned with section 17(2)(2), concession in the matter of rent for the salary taxation. there, if you recollect, in 2001, the perquisite valuation rules were changed very substantially. And for housing perquisite, instead of the fair rental value as a parameter, the percentage of salary was considered as the valuation rule. Because it was in order to remove a lot of difficulties. The fair rental value could have been very subjective. It was very difficult to say what is a fair rental value of a particular property, especially when it is in a remote area. So therefore, the simple rule was you take the percentage of the salary, 7.5% of the salary of the employee, and that is the fair rental, that is the value for housing accommodation. Now here the employee who was availing the benefit of the employee quarters, what he argued that 1722 says concession in the matter of rent. So therefore, concession is a basic fundamental condition. It is a jurisdictional fact required to be established. Now, when all the employees who are availing similar quarters are charged the same amount of rent, there is no concession, and therefore there is no perquisite. And this argument was accepted by the Supreme Court. And that they said that yes, concession is a jurisdictional fact required to be established. It's a sine qua non for exercise of the taxing power. There is no deeming fiction in 17.2 to say that if the recovery of rent is less than the specified percentage of salary, then a concession shall be deemed to exist. No such deeming fiction is there in that section. And therefore, unless and until a concession is established, the perquisite taxation cannot be applied. So therefore, after the Supreme Court ruling, section 17.2 was amended to bring in an explanation to create this deeming fiction, to say that if the recovery of rent from the employee is less than specified percentage of salary, which is 7.5% or 15%, then concession shall be deemed to exist, and therefore a perquisite shall be deemed to arise. Now, in case of 28.4 or 194R, there is no such, at present, there is no such deeming fiction. Now, let us take, if the FAQ is saying that it can be taxable under any other provision, 41(1) or any other act. Now tell me which other provision has both these conditions: benefit, perquisite, whether convertible into money or not, and a nexus with business or profession. 41(1) does not have that. 41 talks about remission of trade liability, etc. So therefore, there is no other provision under which both these conditions will get fulfilled. It is only in 28.4 where this condition will get fulfilled, and therefore it should be restricted in application to only to 28.4. If this is not accepted as the correct, if you go by FAQ 1, then what is the extreme proposition that can arise? Like, let's take a simple example that a person is investing in shares of a company. Now that share capital will remain permanently with the company. It has no obligation to return. It will pay dividends only if there is a profit. So can the tax department now say, look, this is a benefit or perquisite to the company, and therefore when I'm making the if any company which is in business and fulfilling this turnover criteria, whether it has to deduct tax while making investment in the other company. That will be too radical. I would feel it's an absurd interpretation, and therefore the FAQ 1 may not be fully correct, is my personal view. Of course, it has to be tested before the courts. Next is the monetary benefits. Again, a very controversial issue on FAQ 2. So we have seen that FAQ 2 takes support from proviso and says the proviso clearly indicates that it covers monetary benefits. Now this proviso is borrowed from TDS on lottery winnings under 194B, and it covers two situations: wholly in kind and partly in kind or partly in cash, but the cash component is insufficient. In that case, the provider has to ensure that the payee has paid the tax. Now, taxpayer can argue that this proviso has been inserted just to make sure that the taxpayer does not take an argument of impossibility of performance for in-kind payment. Suppose I am giving a gold coin. It is impossible for me to deduct something and give the balance of the gold coin. And therefore, this now proviso says, okay, if you cannot deduct, then you ensure that the payee has paid the tax. And now FAQ 9 says, okay, you take the advance tax, challan, etc. So therefore, it is to preempt the argument of impossibility of performance. It does not clearly indicate the legislative intent to cover monetary benefits, because legislature was always aware of the two Supreme Court rulings in case of Motilal Gangabai and Mahindra and Mahindra. So if the legislature wanted to cover monetary benefits, it could have simply omitted the phrase whether convertible into money or not. That was the simplest task which the legislature could have done to make it very clear that 194R will apply even to monetary benefits. Now, if this interpretation is not correct, if the interpretation is that it also covers monetary benefits, then there will be a huge problem, because it will cover all the regular payments which are already covered by TDS under other sections, and where a lower TDS rate is prescribed. Let's say you are making contractual payment for the existing contract, which is under 2%. Now, is it that for the new contract which you enter after 1st of July, you are required to do under 194R? I would believe no. I would take support from circular number 720, which says that you can, all the TDS provisions are mutually exclusive. They cover specific types of payment, and you cannot render 194C as redundant because of the insertion of 194R. You have to give effect to, or there should be harmonious interpretation. You should give effect to all the TDS provisions. Now, if this interpretation is not correct, you can see, the challenge where it will create. If you literally interpret FAQ 1 and 2, which all other transactions, not only the benefits or perquisite that we have in mind, which we saw in the illustrations, but other transaction which can get covered. Let's say remuneration to partners. Today there is no TDS. Now, whether or not it is admissible under 40B, you may have to do TDS. Interest to partners. It is exempted from TDS under 194A under subsection 3, clause 4. That now it says monetary benefit is also to be covered. So therefore, whether you have to do TDS under 194R. You make a lot of payments to banks, and there is a specific 197A1F, there is a notification which is exempting the TDS on payments to bank for several transactions. Okay, so those transactions will remain exempt, but there are certain transactions which are not covered in that notification. So for example, simple bank charges, statement charges, passbook charges, you are making payment to derivatives, you enter into forward contracts, you enter into principal only swap, interest rate swaps, etc. with the banks, and you suppose you have to make the payment to the bank. For the bank, it is in the regular course of business. So are you supposed to now deduct TDS in the name of the banks for all these transactions? Donations to scientific research institutions. Suppose, the scientific research institutions are engaged in the business of doing research, and you are making a donation. Now, you are not availing any service, but you are simply making a donation. You have not availed the concessional tax rate under 115BAA, so you can claim, the benefit of the deduction, 100% deduction. Now, there are you supposed to now deduct tax while making such payments? So all these questions, doubts, controversies will arise if you take the interpretation. If you take a very blanket interpretation that FAQ 2 has to be interpreted very liberally to cover all types of monetary payments. So this is a sort of absurdity which can arise. Moving on, FAQ 3. As I mentioned earlier, it says that benefit or perquisite can be received in the form of a capital asset. And that, I believe, is the correct principle. Illustratively, you have the Allahabad High Court decision in case of Ram Kripal Tripathi, where a car was received. I also talked about Priyanka Chopra's ruling, which car or a watch was received. So, while explaining this principle, if the FAQ had restricted to these two rulings, it would have been very fine, not created any confusion. But then it goes on to refer to some other rulings, and which creates a fair amount of confusion. Take the first ruling, Ramesh Babulal Shah. It says SSC entered into an agreement with J for purchase of a plot of land, and certain amount was paid as earnest money. However, possession of land was not given to SSC, and seller entered into another agreement with a third party to develop the said plot. SSC filed suit in which a consent decree was passed, and in pursuance of the same, certain amount was paid to SSC. On appeal, it was held that such sum received in pursuance of the consent decree was liable to tax as business income under 28(4). Okay, this was a monetary receipt. We received compensation for some breach of the agreement by the other party. This argument of 28(4) not covering monetary benefits was unfortunately not raised in that case, or not noticed, or not observed by the court. And the dispute before the court was whether this transaction entered by the SSC was an adventure in the nature of trade, or was it a capital asset. So whether he received this income was assessable as capital gains or business income. And the court finally held that it was in the adventure in the nature of trade, and therefore it is taxable as 28(4) income. But what was received was money. Now, how is this an illustration for receipt of a capital asset? That is creating confusion. The second is Ramaniam Homes, where it was a loan waiver. So how can, and this decision has been reversed by Mahindra and Mahindra. So again, the confusion arises why this is referred despite being reversed by Supreme Court. I think the logic of the CBT while drafting this FAQ or giving this illustration is, look, we have clarified in FAQ 1 that you don't need to see the taxability at the hands of the payee. So for the borrower, based on Mahindra and Mahindra, this may not be taxable. But in FAQ 2, we have also clarified that it covers monetary benefits. So Mahindra and Mahindra said, because it is monetary in nature, it is not covered by 28(4). So we are countering that. So because of FAQ 1 and FAQ 2, it is a monetary benefit, and therefore, even if it is on capital account, it is liable to TDS. It's a capital, but in loan waiver, loan was never a capital asset. And therefore, again, this decision creates confusion. Third decision is of Subrato Roy, and he says value of rent-free accommodation, furniture, and fixtures given. Now, he was basically a salaried employee, and he received this benefit, which all normally employees, directors, etc. receive, that he can stay in the house. Ownership is not transferred to him. So how is it a capital asset received in his hands? So, again, this is not a proper illustration to explain the principle that a capital asset can also be taxable as benefit under 28(4). So all these decisions sort of create a huge confusion. I will not take for the want of time. We can discuss it later on. But these decisions create confusion. But I think the principle is correct that you can receive a benefit or purchase it in the form of a capital asset. Now coming to FAQ 4, very important, as I discussed, it makes a distinction between, on one hand, sales discount, cash discount, rebate, not liable to TDS. On other hand, any other form of benefit, including free samples, liable to TDS under 194R. So in first and second para and third para, it covers both financial and quantitative discounts. Third para, it specifically gives the example of quantitative discount, that if you give 10 units and then if you give 2 units free, then 2 units is a discount. Now there, it talks about the same, you get a feeling as if it is talking about the same product. 10 units of X and 2 units are also of X. It is talking about stock in trade from a stock in trade items which are given by a seller from a stock in trade. In my personal view, even if it is not same products, even if it's like 10 units of X and 2 units of Y, it should get covered as a quantitative discount. And this, this issue was, appreciated by the CBDT officials in one of the events, IFA events, and where they said, yes, we will examine this and we'll issue the necessary clarification if required. Now, the logic behind this, the first category being given exemption 194R is it's a lesser realization of sale price and the reduction of purchase cost for the buyer. But cash discount, if you see, does not meet this test, and yet it is given the clarification. Cash discount is normally recorded as a separate expense in line item in the P&L. That is a basic accounting treatment that we have been taught from FIJC onwards. It is not reduced from the sale consideration, neither it becomes reduced from the purchase cost. But fortunately, cash discount is also being clarified as not liable to 194R. So this clarification can be usefully relied by the taxpayers. Now, rebate. Now, rebate, what will get covered within rebate? Now, if you look at the dictionary meaning, judicial meaning, rebate has been explained very widely. Its scope is very wide. So, I have just given, for example, illustration purpose, one of the paragraph from Bombay High Court decision in case of Harrier Cotton Pressing Factory, where it has been said, rebate on the other hand is a remission or payment back and of the nature of a deduction from the gross amount. It is sometimes spoken of as a discount or a drawback. The dictionary meaning of the term includes a refund to the purchaser of a thing or commodity of a portion of the price paid by him. It is not confined to a transaction of sale and includes any deduction or discount from a stipulated payment, charge or rate. It need not necessarily be taken out in advance of payment, but may be handed back to the payer after he has paid the stipulated sum. The repayment need not be immediate. It can be made later. And in case of persons who have continuous dealings with one another, it is nothing unusual to do so. So rebate need not be given immediately. It can be given much after the sale transaction has been over. So it has been interpreted very widely. Now questions, etc., doubts will arise. What all transactions it can get covered? So here we have to remember the logic which is given for the distinguishing between the lesser realization of sale for sales discount, cash discount, and rebate in first 3 paragraphs versus the benefits which are listed in the 4th paragraph, which are cash incentives other than discount or rebate, and other items like the car, mobile, gold coin, sponsored trip, free medical samples, etc. So you have to be able to distinguish between these 2 classes. Now you can consider, in some case, rebate, if it is given directly as a reduction of the purchase price, it is fine. You may give it as a credit note, that is covered. But in some cases, we have seen that the transactions are little peculiar. Sometimes manufacturer issue credit notes to the distributors for items like manufacturer may tell the distributor that I want to promote a new product. So therefore, I am asking you, you engage, you employ extra salesmen and do very aggressive marketing, and I will reimburse you the cost of those sales, salary of those salesmen. And then the distributor engages those salesmen, incurs the salary cost, and puts up a debit note, or he may also raise an invoice. In many cases, we have seen that for GST purposes, they actually raise an invoice. And in many cases, in some cases, we have seen that the manufacturer, when he makes this payment to the distributor, he deducts under 194C also. Now, whether this reimbursement of salary of extra salesmen can be called as a rebate. Now, I would put a question. Look, he has given a credit note, fine. What if instead of giving a credit note, in the next invoice that he raises, he had given discount of a similar nature? Would it not have got covered as a discount or a rebate? Yes. So then what is wrong in giving a credit note? I'll say, is it comparable to any of the items which are prescribed in the 4th paragraph, which is, let's say, gold coin or foreign trade, etc.? No. Is it a benefit or a perquisite? Here I will ask the same question. Is it a benefit or perquisite to the distributor? Distributor did this because manufacturer asked him to do so. Then it's a reimbursement of a necessary expenditure. Can you say that is a benefit or a perquisite? So, maybe a taxpayer can argue that it is rebate, and therefore, there is no TDS required. If they are doing TDS under 194C, well and good. Very well. You can still argue that it's already covered by one TDS. How can it get covered by 194R? Similar such situations, you can multiply those situations, like a manufacturer asking a distributor that he has to also cater a distant location, where the distributor says, no, I will incur extra freight. I may not be able to have that margin. So therefore, the manufacturer says, okay, I will reimburse you the extra freight expenses. Now, when the distributor makes the freight payment, he does TDS 194C. Now, when the manufacturer issues a credit note, will it be a rebate or not? Again, I will say, follow the same logic. Taxpayer will argue it is a rebate only because I could have very well given it as a discount. In that case, I would have in fact charged lesser GST. Now here, GST is not impacted, or distributor raises a GST invoice on me for this particular reimbursement. Or let's say, very simple example, fixed quantum incentive, that if you, not percentage of the sales incentive, or percentage of sales, but say if you purchase 1 crore, or if you sell 1 crore, an amount of 1 lakh rupee will be given to you. If you sell 2 crore, I will give you 3 lakh rupees. If you sell 3 crore, I will give you 5 lakh rupees. Now it is not as a percentage. So whether it can be called as a rebate, I would argue that yes, it is a rebate. It's a reduction in the sales price, and it's a lesser realization of sales price and a reduction in the purchase cost for the distributor. Of course, but this is all debatable. It's my personal view. Some of you may agree, some of you may not agree. Tax department definitely may not agree. Then the next situation comes where the benefits are not given directly to the distributors, but somewhere down the chain. For example, along with the product, certain QR codes, coupons, scratch cards are given, and the retailer or the final consumer can just go onto the app and scan the QR code, and the direct payment will be made to their bank account, or they may be given a gift. If it is a gift which is given, if it is to a retailer who is carrying on business, of course, 194R will apply. But what if it's a cashback? It's a sales discount. It's just money is given. In that case, two arguments. One is 194R does not cover monetary benefits, despite whatever FAQ2 may say. Second is it's a discount. It's a rebate, because it may not be that it is directly he had purchased the goods directly from the manufacturer, but he is purchasing the goods manufactured by the manufacturer. Therefore, and this amounts to this rebate or a cashback results in a reduction of the purchase cost. And therefore, it can also be regarded as a rebate, is my view, but of course, this is debatable. In this QR codes, coupons, one thing we have to bear in mind. If there is an element of luck, if they say that whoever is the lucky winner will get some car, etc. Now, there I would believe it will go under lottery winners. So, if there is an element of luck involved, or gifts are based on luck, then I would say TDS under 194B at 30% should apply, and not 194R at 10%. So that distinction we need to be kept in mind. Next, you say, if I am arguing so much that, these kind of transactions are rebate. So is it that everything will get covered under rebate? Then what is the, meaning that you give to this sentence, first illustration in 4th paragraph, when a person gives incentives other than discount rebate in the form of cash? What will it cover? So my answer to that, of course, again, subject to debate, is that, subject to legal view on non-coverage of monetary benefits, is a take example of cash grants to doctors in violation of MCI guidelines. So this was happening in the past. Now it may not be happening because of MCI guidelines, but if these cash grants are not in the course of a regular business, it is not a lesser realization of sales price, it is not a reduction in purchase cost. So therefore, it can get covered. If you take the argument that monetary payments are also covered, then this is an example for the doctors. Otherwise, if you take a view that all monetary payments are covered, then it will overlap with other TDS provisions under 194C, H and G. We move ahead. FAQ 4 also talks about free samples. Now here we make a distinction between medical sample and non-medical sample. Now in case of non-medical sample, we will just discuss first non-medical sample first. The question that you ask is it a benefit or a perquisite? Suppose I go to a sweetmeat shop. Do I not ask for a small piece just to taste it before I place an order for 1 kilo or 2 kilos? It's a very normal tendency on part of the buyers. Now, FAQ says that no, the relaxation for cash rebate, discount, etc. does not apply for free sample. A medical sample is one thing, but they say relaxation for this relaxation does not apply to free samples at all. So therefore, and this relaxation is granted only to these items, sales, discount, and rebate, and not for any other items. So therefore, as if free samples are now benefits and perquisite, and the CBDT expects you to deduct TDS under 194R. If you look at the various situations in which free samples are given, wide variety of cases. Now, if you, there is a concept of tester products for perfume, specifically for perfumes. If you go to a mall, you want to buy a perfume, there will be persons, employees who can put it a small quantity on your hand, you will smell it, and then you decide whether you buy this perfume or the other perfume, etc. Or you don't buy or don't buy at all. At tea auctions, tea samples are provided just for tasting the tea before they can bid in the auctions. If there is a new product launch, you normally see sometimes all of us one find in the newspaper, you see there's a big ad, new product is there of a shampoo, and a small sachet is also given in the newspaper itself as a sample. You can use it and to evaluate it. FMCG companies appoint marketing agencies who will have salesmen who will go from door to door, and they are given small packets of samples to give to these people to consumer outreach program, and they give it to this all the consumers, and they take a feedback also how they have found it. If you are buying a new house or renovating your existing house, you need plywood, laminates, etc., tiles, etc. You go to a shop and you will see that product catalogs are there where the small laminates, small tiles, or if you want to buy curtains, etc. So there actual small pieces of those curtain, there's a full product catalog which is given. Now, these are all samples just to test it, feel it, how will you take decisions or buying decisions. In B2B transactions, all of you may say it is a B2C transaction, but in B2B transactions also, sometimes when a new chemical is, a manufacturer is having a new chemical, he wants to give it to, sell it to its customers, and the customers are a little apprehensive. And what he says, okay, take a small sample, use it in your, test it in your lab, or use it in your machinery, see how the production comes out. Then you need to decide for yourself whether you want to buy it or not. So it may be given for testing purposes. Now, in all these transactions, we will ask the question, where is the benefit or a perquisite? It's a bona fide business transaction. It is not for giving any personal benefit to any of these people. Now, if you do, at what level you do TDS? Now, to say all these samples are given from manufacturer to distributor. Distributor takes it and gives it to the retailers. Now, as I said, you may give it to the newspaper company to even put it in the newspapers. You may give it to the marketing agency, and marketing agency will give it to the door-to-door salesman. Is that, at all the stages you will do the TDS? Now, what will happen if the distributor, suppose the manufacturer does the TDS in the name of the distributor, and the distributor gives it to the retailers. So what the distributor has to do? It has to claim the same amount as an expenditure in its computation, even though there may be no entry in its financial books. But if moment it sees that under 26 years and this tax has been deducted for the value of free samples, it will have to claim a corresponding expenditure. Otherwise, it will be a huge tax outflow. Also, this is a sunk cost. This is a blockage of working capital for them. Only on the samples, they have not received any benefit. So again, a big issue on the free samples. And somewhere, the CBDT, while trying to keep medical samples out, and they may have any views on in the pharma sector, etc. But for a non-pharma sector, this is going to be a huge problem. Now, here we have to make a distinction. At least I personally believe that you have to make a distinction between joint products and free samples. Sometimes you get a free product, small quantity of a free product along with the main product. So 1 liter of X oil pouch free with a 5 liter can of Y oil. Okay, so that is given because this X is a new product, and just because to elicit interest in that product, they are giving it free. Later on, even X oil will be available in 5 liter coil. So that time you are paying the price for 5 liters of Y oil. So therefore, say that it comes along with the X. So it's a joint product. It's not a free sample, even though the motive may be sample. Similarly, one toothbrush in 250-gram toothpaste pack, new toothbrush is put in the toothbrush pack and given to the consumer. So now here it is intent may be sampling, but it's a joint product. So therefore, I believe personally in these cases, no TDS is required. Then you come to free medical samples. Now this is a very controversial area because I think somewhere the CBDT believes that there is this practice is there is many unethical practices taking place in the pharma sector, and that they want to curtail somehow or the other. So what they believe is this free medical sample. Normally we ask it, the question is the doctors, even if they take it from the pharma, it cannot be sold. It has to be necessarily given to the patients. So how is it a benefit or purpose? And the taxpayer may try to argue that relying on SKF's ruling in Supreme Court by saying that it is a sale, advertisement, publicity or sales promotion for the pharma company. There is no benefit to the doctor because he cannot, even if he consumes it, fine, but it is maybe a benefit, but he has to necessarily give it to the patient. Lot of cases it has to be scrapped. So how is it a benefit or a purpose? Look at fringe benefit tax. In 2005, you had an FAQ 64 in that circular number 8 of 2005, which said free medical samples by relying on Supreme Court, it is a sales promotion. However, immediately based on representations in 2006, medical samples are brought out of the FBT. And in 2007, all other samples are also brought out of the scope of FBT. So there was no FBT. So why did you do that? Because it's a bona fide business practice. There is no benefit to anyone, neither the employees nor to others. MCI guidelines do not prohibit. Now, MCI guidelines, you have Apex Lab, right, where it was considered any freebies given to doctors which are prohibited by MCI guidelines. There you have to do TDS, I agree. But MCI guidelines do not prohibit doctors from receiving the samples. Okay. There is a uniform code, UCPMP, which is a voluntary guideline for the pharma sector as of now, which prescribes how the samples have to be given. And there it lays down very detailed conditions. So it has to be given only on exceptional basis, at the request of the doctors. You should take the acknowledgement of the person who has received it. It should be the doctor himself or a person authorized by the doctor. And this is given for the purpose of acquiring experience in the dealing with such a product. Then there are conditions. If there are 3 different sizes, you should give the smallest size in the market. You should give only the dosage which is for the 3 patients for their treatment, not more than that. So there are various conditions which are prescribed in this CPMP just to regulate how the samples are to be given. So therefore, the taxpayer may want to argue that if I'm in compliance with all these guidelines, it is not a benefit or a perquisite. The regulators don't consider it as a benefit or perquisite to the doctor. They don't prohibit it. And therefore, it should not be a benefit or a perquisite. However, we have to also understand the CBDT's views, which we got it, in the discussion during the E5. What they said is that, yes, these products are marked as not for sale, but that does not mean that, it is not a benefit or perquisite. It has value for the doctor, and therefore it is a benefit or perquisite. Next, there is a confusion between clinical trials and gaining experience. What they say is the pharma industry argues that it is for trial purpose it is given. And then they say that no, trials can be done only in a regulated mode. There should be an ethics committee approval taken. There should be appropriate documentations. The samples cannot be used for clinical trial. There is a separate procedure for doing clinical trials. The samples which are distributed, which you find in the market, they are all clinically approved. They are not for clinical trials. Even for post-marketing surveillance, a specific protocol is required to be followed. And therefore, they say that the samples which are normally given today are not based on clinical trials. Now, UCPMP says that samples have to be given for acquiring experience by the doctor. So therefore, doctors acquire experience, and therefore it's a benefit or purpose. And lastly, the practice, the doctors can charge higher fees because they are giving samples. So these are the various arguments which, the CBDT may put across if this particular FAQ 4 is challenged before a court to say that why they believe that there is a benefit or purpose. Of course, this is a very sensitive area. It may go to the courts. It may be challenged. We'll have to see how the courts look at it. Now, practically, if the pharma industry says that, okay, we don't want to litigate much, we want to comply with it, and we will deduct TDS on these samples. No doctor will accept. That is a fact of life. That no doctor will say that this is my benefit or purpose. I give it to my patients. I do not consume it myself. So doctor is not going to share. No doctor is going to share. Most doctors are not going to share their PAN. So therefore, the pharma industry will have to do TDS at a higher rate, under 20%. And there could be some cases of abuse also. We cannot rule out that you get the MR, the medical representative gets a PAN of some of the doctors. Then all the samples which are given to doctor, he may just load it onto wherever the PAN is given, and then for doing 10% TDS. So therefore, this is going to create some challenge. And as FAQ4 itself says, in case of hospitals, you have to do a dual TDS. Now it goes. Now let's take for the example of a consultant doctor. At least he has the scope to say that, okay, if it is taxed as my benefit, as my income, moment I give it to my patients, I can claim an expenditure because it's under business income taxation if he's under net basis of taxation. Now, if you tax it as salary of the employee doctor, what it will just add to his income, and some TDS will be deducted from his salary, and where the sample has gone to the patient. So it is going to create a huge challenge for those kind of cases. We go to the social media influencer, FAQ6. Now here, as I said, the first sentence of FAQ says lays on a very important principle. Whether benefit perquisite is there depends on facts. I believe this should permeate across all the cases. You have to look at the facts. Benefit arises if product like car, mobile is allowed to be retained, and we have this Priyanka Chopra example. The problem is where it refers to outfit or cosmetics. Now, outfit or cosmetics are sort of personal use products. Maybe once you have used an outfit, then it cannot be used again. So therefore, is it possible to argue that items which are consumed in the shoot, or with outfit, etc., or cosmetics, or let's say food or hotel stay, then these should not be considered as a benefit or a perquisite. And here, based on our discussion with CBDT officials, they seem to be aligned with this principle, that if it is consumed in the process of rendering services, which is for shooting that ad, or for the content, video content for putting on YouTube or Facebook or Instagram, then it is not a benefit or perquisite. But if you tweak the facts a little, it can change the conclusion. For example, a social media influencer is allowed to stay for 5 days in a hotel, where the shooting takes place for only 2 days, and balance 3 days, it is his leisure. He's allowed to just stay, for leisure purposes. There, my view would be that for 3 days, it's a benefit or perquisite. There you should deduct tax in the 194 hour. And again, I have this cosmetics example. Maybe 1 unit, you give 3 units, 1 unit is consumed in the shoot, and balance 2, the person is, the social media influencer is allowed to retain himself. Then I would say that at least that 2 units, there should be a benefit. It's a benefit or a perquisite because he can now use it for his personal consumption. The challenge will be how to, identify all these cases, how to track it, how you will strengthen your contracts to say there is a return obligation, etc. But that is the challenge which the industry is facing right now. Now, as I discussed, whether this same principle that if it is retained, there is a benefit. If it is returned, there is no benefit. If it is used for the purpose of rendering service, there is no benefit. Can it be extended to other situations also? And I personally believe, yes, it can be done by placing reliance on the logic given in the FAQ6. Whether there is a benefit or not, it depends on facts. You take certain very common examples. FMCG companies give refrigerator, soft drink company give refrigerator with their brand logo to the for the retailers to store the soft drinks, perishable items. They have to store it in a very prominent place. They cannot take it anywhere else. They cannot sell it, scrap it. They have to use it. The software company can take it back, give new refrigerator when the brands have changed, etc. So it is under the control of the manufacturer. Then I can argue that even though this refrigerator is kept for its entire economic life, there is no benefit or perquisite. The retailer cannot take any depreciation or any advantage on that refrigerator. Similarly, in manufacturing industries, the brand owner may invest in the mold and give it to the contract manufacturer for the production, so that it reduces the investment of the contract manufacturer. He invests only in machinery, raw materials, etc. In that case, also I can say that the ownership in the mold always belongs to the brand owner, and therefore it is not a benefit or perquisite to the contract manufacturer. You will see that point of sales display material is there. When you go to the malls, there are standees or something. Some retailer, you see there the boards are made by the manufacturers, etc. So all this logic can be extended to any this type of situations. Next comes on the FMV determination. Suppose this agreement is for 2 years, for using for 2 years, and thereafter it can be retained by the other person, by the service provider. So whether this 2 years depreciation can be considered, can be reduced in the perquisite value. Because if you see in salary perquisite taxation in rule 377, when an employer gives an asset to the movable asset to the employee, the perquisite value is computed at the written down value after taking into account a depreciation. So 10% for some general, then 20% for cars, 50% for computers, etc. Whether the same logic can be applied over here also, because otherwise, if you apply FAQ 5, which says in case of purchased benefit, it's the purchase price. If you purchase the benefit, it's the purchase price should be taken. Then it will create a difficulty. But I believe if it has been used for certain purpose and then it is allowed to be retained, this depreciation should be considered. Of course, it is subject to litigation. Then another difficulty is that the FMV is the captive benefit by the service provider by the hotel or airline. A manufacturer will have the manufacturer's case is covered, but a hotel provides its own stay to its travel agent. What is the price? What is the FMV it can consider? Because it can have different prices based on the customers. Individual customer different price, corporate customer different price, tour operator different price, etc. So which price should be considered? Even same is the case for airlines also. This can create some challenge and they may have to take a very reasonable view in the matter, taking a very comparable situation in mind. Let's go to reimbursement of expenses. FAQ 7. Now, again, a very controversial issue. As I said, there is a significant overlap. If you say that any reimbursement where is the invoice is in the name of the service provider, you should do TDS under 194R, then basically makes FAQ 30 of 715 redundant. Now, there could be different types of reimbursements. Based on our experience, I have tried to classify in 4 types. One is the reimbursement of core expense. You have manpower supply agreements on a cost plus basis. So, the 100 rupees is the salary provided to the outsourced employee plus 10 rupees or 5 rupees is the markup. So, in that case, you will apply on the entire amount. Let's say 194C. If it's a contract for manpower, it's going to apply 194C. So it is covered by 194C. It is not covered by 194R. Second category is which are incidental to core services. So like auditors, lawyers, their main service is a professional service, but they also travel, and they claim out-of-pocket expenses. Now, technically, one can argue that there should be no TDS on this reimbursement because it is incidental to it is not for the rendering of the services. It is the expenses incurred for the purpose of rendering of the services, which is the incidental expense, not a core expense. And therefore, there should be no TDS. However, you have FAQ 30 under 715. And if you are doing TDS under 194J, then as such, there is no requirement again to do TDS under 194R. The conflict can arise where it is under FTS, under 194J at 2%, where the department might say by relying on FAQ 7, it might say you should have now done at 10%. Third category is the intermediary or a pure agent. You say customs agents, CNF agents. They incur expenses on behalf of the client and they raise 2 bills. One only for the expenses, another for the agency charges. Now, agency charges, normally the 194H or 194C, whatever is the relevant TDS, that is applied. And for the reimbursement of expenses like freight, customs duty, IGST paid, or demurrage charges, go down charges, etc., no TDS is done presently. On this, if these underlying payment is liable to TDS, normally these agents will do the TDS. For example, freight, it's covered by 194C. They will do the TDS under that. So therefore, it is arguable that there should be no further TDS on these reimbursements. Now, this will come under litigation because of FAQ 7. But here it is possible to argue that FAQ 7 is dealing with out-of-pocket expenses, etc., for a consultant service provider, and it does not cover this pure agent type reimbursements. Of course, subject to litigation, this issue has also been highlighted to the CBT officials, where they have appreciated it. And as I said, their logic was that for the expenses, the service providers claim ITC credit. So therefore, it becomes their own expense. So if that logic does not apply over here, yes, we can also say that, therefore, it should not be liable to TDS under 194R. Another category is cost sharing arrangements. I would say big premises is taken on rent by the parent company. It is shared by all the group companies. parent company, when it pays the rent to the landlord, it deducts the TDS under 194I. And the other companies who use pro rata portion, they pay their share of the rent to the parent company. At that time, there should be no TDS. I believe that should still hold good, even despite FAQ9, because there is no benefit or a perquisite to the parent company in this particular case. It is a cost sharing arrangement. Where the reimbursement should be liable to TDS under 194R, I personally believe it should be only for reimbursement of personal expenses, which I relate back to circular number 20D, which says rent-free accommodation given to the lawyer. So if you are reimbursing the rent of a accommodation for his personal accommodation of any service provider, etc., then it should be liable to TDS. But first you should see TDS under the normal provision, whether it is covered by 194C, J, etc. Then you come to 194R. Now, in case of rent arrangements, we will face some difficulty because normally the electricity charges or water bills, the bills always come in the name of the landlord, and the bills never come in the name of the the tenant. And under the agreement, the tenant is supposed to, because he is actually using this electricity, water, etc., he is supposed to reimburse the landlord, either pay directly or to pay to the landlord. So there we will have this difficulty if no TDS is being done today. We move on to the dealer conferences, FAQ 8, where I said the second paragraph, which says that select dealers if you are providing any conference, that is, they say that it is liable to TDS under 194R. It can be interpreted in two ways. I have also explained how it can be interpreted in two ways. Now, suppose you go with the department's interpretation and say the entire conference expenditure is liable to TDS whenever you are estimating on select dealers. Now, consider that a company has got 4,000 dealers. If it wants to call everyone, where will it accommodate them? It is not possible. Logistically also it is not possible, and their budget may also not permit them to call everyone. So therefore, out of necessity, they select performance as the criterion, and then they invite select dealers based on their sale, based on the performance of their sales, target, etc. So in that case, if the conference is otherwise satisfying all the ingredients of paragraph 1 of FAQ 8, I personally believe there should be no TDS. On the third paragraph, very fortunately, it is saying expenditure attributable to those components. So it is not the entire expenditure on the conference. You have to identify the expenditure attributable to those elements like leisure trip, incidental leisure component. Now here, of course, there will be debate whether you will consider gala night or cocktails as a leisure component. No, I would say that food is never a benefit or perquisite. Any food, whether it is a 3-course meal or 5-course meal, etc., should not considered as a benefit. Even the alcohol, if it is distributed in such conference events, it should not be considered as a benefit. Other person, some of you may not agree. The tax department may agree or not agree. Nobody knows. But that stand may be taken by some of the taxpayers. Leisure trip is like you organize a foreign tour. You keep a conference in, like, suppose in a foreign country, European country, and then you organize a city tour for them. This because you have taken them all the way to a different country. Now that particular leisure trip will constitute a benefit or perquisite, and that I think fairly should be acceptable also, because if they get a personal benefit of that, it may be incidental to the overall conference, but now CBDT says no, yet you should consider a benefit and perquisite, deduct tax on that. Now here the challenge would be that how do you identify the persons who actually avail the benefit? Suppose the leisure trip is arranged for 100 people and only 40 people avail it. How will you allocate it between all? Whether the entire cost you will allocate only on these 40 people, or you will allocate over all the 100 people and you deduct TDS in the name of all the 100 people, or whether you only on this 40 people pro rata cost of this 40% only. Which is the third is the more rational, logical view. Otherwise, the first two will have a very absurd result. The prior and the overstay. Now, there I believe that, and also the CBDT officials are also in agreement with this. Maybe it will come as a clarification, or maybe not, but we can take a reasonable stand that because of the logistical reason, flight timings, etc., you come one day earlier to the conference and you then move out one day after the conference date. It should not be considered as a prior stay or an overstay. So that's a reasonable stand. It is only where it is, prior stay 2-3 days before, just to, have a personal leisure tour, etc. of that location, etc., then it is a benefit or a perquisite. In pharma industry, there are CME events, continuing medical events. So there one has to be very careful because MCI guidelines prohibit giving travel and hospitality as a delegate to the doctors. So if you are incurring their travel expenses, hotel expenses, etc., it may be regarded as a benefit or perquisite because it is prohibited for them. If same expenditure when you incur for dealers, etc., no problem. But even for doctors, and even if the event is only for these technical discussions on a new area of therapy, etc., still the MCI guidelines are very strict, and therefore one needs to be very careful over there. And if it is you are incurring travel expenses and hospitality, you have two challenges. One is the TDS, and the second is the disallowance of the expenditure. But otherwise, if you are doing that CME event within the boundaries of MCI guidelines, you are not incurring the travel expense of the doctors. You are not expensing the the hospitality. Also, food is moderate. You are not giving lavish dinner, etc. You have taken a legal view that it is. You have taken a law firm's view that it is within MCI guidelines, etc. And you are incurring expenses on the venue, rental of the LCD projector, etc. It may be possible to take a view that it is not a benefit or a perquisite. Next, we move to FAQ 9, TDS on in-kind payments. There, there is a one peculiar feature. The advance tax you pay in 4 quarters, 15 June, 15 September, 15 December, and 15th March. Now, whether you will require, like suppose you are giving a benefit in the month of April, let's say April 23 next year. Now, whether the recipient can say, okay, I will pay advance tax on 15th of June, I am giving you a declaration, so don't deduct TDS. I believe no. He will have to pay advance tax. Now, 15 June is the due date. You can pay it, always pay it earlier, it is still an advance tax. So you may need to insist on payment of advance tax, at least equivalent to the value of the TDS on the benefit that you are giving, even though advance tax is to be paid quarterly. But let's take an example that person has paid 1 lakh rupees as advance tax in the month of 15th of June. You are giving, let's say, benefit of 1 lakh for which TDS is 10,000 rupees in the month of July. And he shows you this 1 lakh rupees challan in the month of July that you consider. Now, again, you give another 1 lakh rupees benefit in the month of August. Now, there you have to see now another TDS is 10,000 rupees, so total 20,000 rupees. But if he has paid 1 lakh rupees as advance tax, which fairly covers the TDS amount, then I feel it should be okay. But if the advance tax paid is, let's say, only 5,000 rupees, and you are now giving him where the TDS amount is 10,000 rupees, then you will have to insist, no, you will have to pay extra advance tax. Then only I will consider your declaration. Now, next comes the gross up. Now, the FAQ 9 covers a situation where TDS is borne by the payer. Okay. Now, it does not, it is silent where TDS is recovered from the pay. Now, I would believe that if TDS is recovered from the pay, then it's a normal TDS. So, therefore, even the due date to be paid is the normal due date under 32. You may, do 10, you may give benefits 10 times during a month, but you are supposed to pay that TDS. If you are recovering by issuing a debit note, etc., you are recovering from the dealer distributor. You can pay the TDS by 7th of the next month as per the regular TDS due date. That should be possible. And there is no gross up required in that case because you are recovering the TDS, you are not bearing the TDS. Suppose you are bearing the TDS. Now the question will come, how do you compute the gross up? Because this FAQ 9 says you should consider that the TDS which you are paying is also a benefit. So let's say the value of the benefit is 100 rupees and the PAN is available. So the TDS rate is 10%. Whether you will do only 11 rupees, you will compute the TDS at 11 rupees by grossing up 100 under 195A. Or whether now you will say that 11 rupees is also now a benefit. There should be TDS on that 11 rupees also. So you gross up another amount. So therefore total becomes 12.2. I would personally believe the first 11 rupees is the, that is a correct view, better view, because if you consider the total benefit that you are giving, the total value is 111. Okay. And you are deducting and depositing TDS of 11 rupees. Now, both the benefit is 111 and you're deducting TDS of 11 rupees, which is 10% of the total value. And therefore, it should be fine. So that is a logic, which appeals to me. And I would put my finger on 11 rupees. Of course, this is also a debatable issue. Next is, suppose TDS is voluntarily borne. I think in free sample, that is going to be the free medical sample, that is going to be the case. That because the doctors are not accepting the TDS, they may not be sharing the PAN, and therefore they decide, okay, we will bear the TDS ourselves. The manufacturer bear the TDS ourselves. Question will arise whether they can claim it as a deduction in their business income computation. And there I see some difficulty because of these three decisions which are on the slide up, Supreme Court, two Supreme Court rulings and one Madhya Pradesh High Court rulings, which have laid down the principle, if somebody else's income tax liability you are bearing voluntarily out of your own volition, that is not your business expense. So therefore, in first case, Abdullah by Abdul Qadir, the SSC was a representative SSC for a non-resident. And because the demands were paid, so he paid it because there was a statutory demand, he had to pay under 163, and then he wrote it off as a business expense. So that was not allowed to him. In Indian Aluminium case, it was a payment of some technical fees to a non-resident, where some position was taken at the time of payment, no TDS was done, Section 201 proceedings was initiated, and he had to pay the amount. The Indian Aluminium had to pay the amount. Then they claimed it as a business expenditure. It was not a net of tax contract, and they were not granted the deduction. So these cases, they give the principle that if you are voluntarily bearing the liability, it may not be allowed. But net of tax, if you have a contractual obligation to pay net of tax, it will fall under a different category. And we have seen in the earlier illustrations of 28.4, where in case of net of tax arrangements, the tax liability borne is under a contractual obligation. That is also a supplementary consideration, additional consideration, and becomes a benefit under 28.4 for the other person. And therefore, that can be taken as a deduction. Of course, PAN is not available. You may need to do gross up if you are bearing the tax liability at 20% under 206AA. Another factor which must be borne in mind that because PAN is not available, you do 20% TDS, etc. But there is a separate provision under 139A5B, and there is a penalty if PAN is not quoted for 10,000 rupees. Now, whether this 10,000 rupees will be, for each of the deductee 10,000 rupees, or it is for the deductor for one particular year only 10,000 rupees, again a very debatable issue under Section 272B1. Of course, there is some circular which says that it is qua deductor and therefore it should be only 10,000 rupees. There is also a ruling, saying that. But of course, this needs to be seen whether how it is applied in other cases also. We move to some different transactions. I am on the verge, of course, while explaining the transactions, I will run up to it now. It's 6:54. 7 o'clock is the scheduled closing time. But let me take only 5 minutes, and we can, I know with the permission of the organizer, we can extend the session for taking some of the questions, which I believe there are only 4 or 5 or 6, which I may be able to deal with it later on. So applicability to other transactions. Now, I'll just quickly cover, let's say Diwali gifts, memento, etc. Now there again, it's a technical issue. You have a legal view that it is not covered by 194R because it's a personal nature. There will be a code of conduct for the recipient employees that they cannot accept gifts of higher amount, etc. Keeping track of 20,000, etc. So the legal view could be that you don't need to do TDS because it's a personal gift. It's not to the recipient entity. It's on Diwali. It's not a sales incentive, etc. But because of the circular, practically you may have to do TDS. You may have to keep track. All the employees of a particular organization. If the total value exceeds 20,000, you may need to keep a track and do the TDS. Small value brand reminders, keychains, pen, diaries, writing pads, calendars, which are given as a normal trade practice. Again, legal view could be this is not a benefit or perquisite. It is just token sales promotion expenditure, but it's not given with the intention of personally enriching, and they may be using in their business, etc. But however, the tax department may argue that we have kept 20,000 rupees threshold limit to take care of all these small items. Therefore, you have to keep track and take. Now, that will create a trade difficulty. Now, when distributors or vendors, you may give body claim benefit. Now, here, the question will be that what is the actual benefit? Whether the payment of premium is the benefit, or the distributor, if he gets actual reimbursement of hospital expense, is a benefit. There, I would believe there is a distinction between the two. Based on the privity of contract, one may be able to take a view that if by taking a mediclaim, the manufacturer, establishes direct privity between the distributor and the hospital, and then manufacturer goes out of picture, and the distributor has to directly deal with the hospital. I would believe that in that particular case, the premium only should be taken as the benefit or perquisite, and not the hospitalization expenditure, which he may get as a reimbursement. Of course, the other view is that, he may or may not get hospitalized. There will be no claim, so it's a contingent nature, etc., etc. That is the other view possible. Bad debt write-offs, I would believe that whether the bad debt write-off is unilaterally by the creditor, whether it is negotiated settlement, whether it is one-time settlement, whether it is under IBC, etc., it is not a benefit or perquisite. Whatever FAQ 1 may say, 41.1 it covers get 41.1, or FAQ 3 gives Ramanian Moon's example. I would believe that in bad debts is not a case where benefit or perquisite arises. In fact, banking industry has approached the CBDT. CBDT is considering giving clarification. Which transactions they will clarify is outside the scope of benefit or perquisite is yet to be seen. But it will create a huge challenge. Let's say 100 crores is the total debt, and you are settling at 10 crores. 90 crores is you take as a benefit, and you have to do TDS. And there is no it has to be borne by yourself only. Then the entire amount plus something more will go out of your pocket as a TDS. So I think it's a big difficulty, but we can expect some clarification on that front from the CBDT. Benefits provided to employees of the contractors or outsourced service providers. There is a lot of case where these people are not your direct employees, but they are employees of the contractors, but you give the benefits like you give to your own employees. So you give transport facility, you give mobile expense, you give free canteen facility. And there are certain nuances because some of the facilities are specifically exempted under the salary taxation. Say transport facility is exempted, mobile expense reimbursement is exempted, no perquisite. Free canteen, there is a 50 rupees per meal limit, but there is no limit on tea or snacks, etc. during working hours. So one may have to take a very calibrated view on what you will consider as a benefit or perquisite, and in whose name you will do, because these are, if you are a service provider, just like your dual TDS mechanism is provided in FAQ, whether you will do it in that fashion or whether you will do it directly in the name of the employees, whether you will not do it at all. Last transaction which I'll take is interest-free loan intra-group services. Their legal view, according to me, is possible to argue that, based on Supreme Court ruling of Salgaonkar, which I discussed, Delhi High Court in case of Asian Hotels, Bharat Hotels, etc., it is possible to argue that there is no benefit or perquisite. It can be argued that this benefit, if at all, is arising from the group relationship, not arising from business or the profession carried on by the subsidiary or the group entity. Even if you don't account, if you don't do anything, his income of the recipient is already higher because no interest is charged, or if you're giving some HR service or etc., if the services are not charged, its income is already higher. So there is no leakage of income per se. In ATIA 10, 115 BA6, it is the other end, right? In this kind of a situation, what the department tries to say is that your profits are artificially inflated because of these kind of arrangements, and therefore will bring down your profits by something. So, this is a converse situation. So here I would feel that, therefore, would say that for not be considered as a benefit or a perquisite, its income is already higher to that extent, of course, but this is debatable. Some professionals are taking the view that if you give interest-free loan or if you're giving free intra-group services, you should do a TDS. Okay, last week, way forward for the payers, for the payees, as I said, you have to check overlap with the existing TDS provision for the payers. Then if you first check whether it is getting covered under other TDS provision, and then you go to 194R. Then wherever, for any particular benefit, you have to consider, you have to take a very calibrated view that what approach you will adopt. Whether to avoid litigation, you will follow the circular, and it will depend upon the stakes involved, the business criticality, your relationship with the counterparty, etc. Or sometimes you want to change the business practice to align with the circular. For example, FAQ 7 says if you take the invoice in the name of the client, then no TDS. Then better take an invoice, better try to take an invoice in the name of the client for the reimbursement. In some cases, you take the professional advice, take a legal opinion, and then take the position contrary to the circular, and then you'll be ready to face litigation. You have to be prepared to face litigation. In some cases where it is very critical, you take a legal advice, and if possible, challenge the circular in the writ. Where it is very difficult business, it's going to be a sunk cost, etc. You feel that the circular is absolutely ultra vires section 194R, and lawyers are strongly advising you. Yes, maybe you can also consider that. Last approach is, okay, you keep your engagement with the government going. Government has also recognized that yes, there are certain further transactions where the circular can create difficulty. For example, one-time settlement, pure agency type arrangements, etc. Free non-medical samples also has been highlighted. So, you can, wherever the sector specific difficulties are there, you can go and approach the government. And if they are getting convinced, they may come out with a further circular. Otherwise, you will have to take a appropriate strategy on different types of transactions. And of course, it goes without saying, if you have to do the TDS compliance, you will have to ensure all the changes in your ERP to track and identify the transaction. From recipient's perspective, what are the safeguards that you will take? Now, basically, now you have to check your AIS Form 26As as a recipient very carefully. If some benefit is appearing there, where the payer has deducted tax and he has not even informed you, but he has borne the tax himself, it could be also possible. If that has been used for your business professional purposes, what strategy that you can do is you can add it in your computation and simultaneously claim deduction. So take, for example, samples are given. On samples, the manufacturer has deducted TDS. Okay. In that case, you can also claim it simultaneously as a business, because you have given the samples to your customers, etc. Then you can claim it as a business deduction. Now there, if the recipient is under presumptive basis of taxation, I see a difficulty. There the question will be whether this can be added as a direct income or whether this goes into the presumptive, it gets incorporated into the presumptive taxation provision, that you don't need to do a separate addition, because this benefit is not total turnover or gross receipts of which you compute 6% or 50%. So this benefit is not your turnover, it is not your gross receipts, and therefore you can ignore it, and you can say the 6% of turnover or 8% of turnover or 50% of professional fees covers the impact of these amendments, and you claim the TDS credit. Also, this is again a little debatable issue. So where the recipient believes that it is not a benefit or perquisite, or the value could be lower, FME has been taken, purchase price has been taken by the giver, but you feel that no, this is not a benefit or perquisite, or the value should be lower because there is no valuation rules. I can rely on the general principle. Now there, you can take a recipient can consider a legal argument that this circular is binding only on the tax authorities and the provider under 194R3. It is not binding on the recipient. So therefore, recipient, for him, it's just a payment of tax. So therefore, the income computation, 28(4), etc., other provisions, there is no amendment. So therefore, he can say that it is not my benefit, or I do not agree to this value. If TDS is recovered by the payer, then of course the payee should claim the TDS credit without offering the corresponding income to tax. If TDS is grossed up by the payer, then what happens? Then you may not agree with the benefit, but TDS has been paid, you can get a credit. So therefore, in that case, I believe that you can claim the TDS credit per se. And lastly, you have to be prepared for litigation if you adopt this position, because under 143(1)(a), this difference between AIS and return, if there is a mismatch, amount can be added in your assessment. And scrutiny assessment, reassessment, it can be captured. And also you will have a tax audit reporting, because if it does not come into your P&L account, you will have to report in the tax audit. So with this, sorry, I exceeded the time perhaps by 4 minutes, and I had promised I will leave ample time for any questions, etc. I am still open, subject to the organizers, extending the time limit for the resolving the queries. Thank you so much for a very patient hearing. Thank you.
Thank you, sir, for such a wonderful session on 194R. So tomorrow government will come up with 194S. Then TU, as up to that they will come. So we'll call you again only.
S is already come. Okay. On virtual digital assets, S has already come. Yeah. So that will come. In Z, then it will be ZA, ZB, ZZ, like that.
Definitely it is going to come. So I request Pradeep, if there some questions are there, can you take up?
Yeah, I'll take them.
Yeah.
Thank you very much, Vijay. Sir, I think most of the questions were already taken up by you, but I'll just read out to them and then you can decide to weed them out. Mostly they were covered by your when you were discussing, especially the FAQs. I'll start with the first question. In case any product given by the company to an influencer for endorsement on social media and no fee is paid, but product is retained by the influencer, in that case, how to deduct tax as the influencer is not submitting any bill for professional for services?
Okay, sure. So I think FAQ 6 covers this, and it says that if it is retained by the person, then you should need to DTS. I would say you start reading from FAQ 6 first, and then whether it is a benefit or perquisite, you decide. Sometimes there can be cases like outfit or cosmetics. It has a one-time use or it's a personal use. It cannot be returned itself. So there you can take a stand. There is no requirement to do TDS. But if you feel it's sometimes a white good, mobile, computer, etc., which is given, then it is retained. Then your FAQ 5 is there. If you have purchased that product and given to the that influencer, you have to do it in the FMV as per FAQ 5.
Okay. So next question. It is a very interesting take. Can capital goods received by distributors for best performance, wherein they are offered for tax, whether the distributor in his books can capitalize this and claim depreciation on that?
Exactly. Yeah, that's a very good question. And in fact, that was one of the representations which was made to the CBDT. I covered it in my slides, that they should clarify that in that case, the fair market value which is considered for TDS purposes should become the actual cost. And that principle is there in many of the sections of the Act. Take ESOP perquisite taxation, take 56(2)(10) taxation. If you're paying tax on that value, it becomes your cost of acquisition and you are entitled to claim depreciation. I would believe, yes, you can claim depreciation on the value which is considered for TDS purposes.
Okay. Next question. If marketing expenses made by the brand on behalf of channel partner, whether the credit note issued by the brand would attract TDS under section 194R?
Again, I discussed this as part of FAQ 7. You have to see what is the nature of reimbursement, whether you're already doing TDS on this provision. Suppose you are doing 194C on the basis that this is the core expense which the marketing agency is supposed to incur, and he is providing you that he is doing work for you. Then you don't need to do under 194R. It is my personal view.
Next question, sir. Whether retail industry schemes of freebies given on certain number of items purchased, example, 1 shirt free on purchase of 3 shirts, whether the free shirt given attracts 194R?
Yeah, here are two aspects. I clarified in my personal view, B2C transactions are out. So if it's a B2B transaction, 28(4) will not apply. Consumer is buying shirt for his own purpose. It's not arising, benefit is not arising from business, perquisite, etc. Even if it's a B2B transaction, we may fall under quantitative discount in the third paragraph of FAQ 4.
Next question is a very different take. If a space for canteen facility is given in the office premises to maybe a caterer, would the notional rent value to the caterer would get covered under 194?
Very good, very good. So again, I will fall back on my interest filion argument or mold given to the manufacturer argument. I'm saying, yes, I'm giving him premises so that now his cost gets reduced. He does not claim the deduction is, his expense gets reduced. Is it a benefit or a perquisite? No, because he requires space to cater to me, which I have given him the space. As per contractual agreement, I have given the space to him. It's not a benefit or a perquisite. So therefore, I would believe that there is no TDS required in this case.
Another interesting take. What if bad debts are written off? Would the bad debts be considered as perquisite?
Yeah, here, as I could not explain because of want of time, shortage of time, I could not explain. When I'm writing off the bad debts, okay, I am doing a unilateral action of writing it off in my books. It does not mean that I have given up the claim. I can still go after the debtor and try to take the amount from him. So therefore, I would say that you may say it is time barred because after 3 years you cannot put up a claim. But from which point it becomes, how should that 3 years be computed is also a little debatable issue. If, like, say, if he has given, the debtor has given you a confirmation, yes, I owe this amount to you in the 3rd year. Now that 3 years time limit may also start from that time. So therefore, I would feel that writing of bad debts is not covered under benefit or perquisite, and it will not come under 194R.
Pradeep?
Next question. Yes, sir.
Pradeep,
Yes, sir.
please carry on your questions, then I will come with the last question.
Okay. Now two more questions have just come in. Sorry, one last question has come in. In today's age, where training can be delivered online, where does one draw the line when it comes to having educational seminars in resorts, 5-star hotel? Does 194R get attracted?
Okay, it's a sort of a little philosophical question.
Yes.
I can technical answer which I can give presently is that so long as this 5-star hotel or resort is only for the aspects which are mentioned in the first paragraph of FAQ 8, product related discussion, setting sales target, reconciliation, etc., etc. I would say that still within the circular, it is not coming under benefit or perquisite. So therefore, you don't need to do TDS if you are sticking to that concept. But as compared to online training, where you don't give other leisure components, if you call them over to 5-star resort and you treat them royally with some leisure components, taking them out for outings, etc., I think there is a personal benefit involved. And therefore, yes, in those circumstances, TDS may be required.
Nilesh bhai, you can take over your question first. You are on mute, sir.
Ravi sir,
Yes,
in this recent case I have seen, a company is sending one employee to say Far East trip or something. Whether that is also covered under 194R?
In my
Explain.
entire presentation, I did not cover any employee related expense, because I firmly believe 28.4 is not concerned with, or 194R is not concerned with employees. Very clearly, even if you take FAQ 1 at its face value, what is covered is benefit or perquisite, whether convertible into money or not, arising from business or profession of the recipient. So if employee is going out of tour, has to be examined under 192, right? So under 192, you have rule 37, which says that if this tour is for his personal purposes, or even for an official tour, if family member is accompanied, then there is a perquisite. Extended vacation, you go for official tour, but there is an extended vacation. The extended vacation is a perquisite, salary perquisite, on which the employer needs to do 192 TDS. So it is already covered, well covered within 192. So therefore, you don't need to come to 194.
The company is deducting this TDS. The company has already told that from 1st July, we will deduct TDS on this.
Of course, if the company would come and take advice from me, I would advise otherwise.
Okay, yeah, yes, Pradeep.
Okay.
Thank you.
In fact, I was going to take up another question in the form that whether 194R opens up an avenue of another small deduction for salaried class, like, where there is a gift up to 5,000, which is there under section 192, and whether we can take up another 20,000 of a gift under 194R.
No, I think not. Technically, I'll give you the technical answer. Everything related to employees is getting covered under 192, fairly covered, very less scope. So therefore, it should not, 194R is not meant for that.
Okay. Another question from my end would be, I don't know, it just clicked to my mind, assuming it is in terms of, say, Diwali gifts. So suppose we are giving some Diwali gifts to our say, customers or to our vendors, but these gifts normally don't go directly to the customer. Basically, it goes to the employees of the customer, right? In our case. Now, you have to look at the 20,000 limit per employee or per qua the customer, basically. Suppose if there are 50 customers are there, so if I have given 1,000 rupees of a gift to 50 employees of their customers, so whether 50,000, 20,000 limits get split or no?
Yeah, so I tried to cover that. So in Diwali gifts, a legal or a technical argument is that I am not giving it for any sales incentive, etc. Diwali in India, it's customary to give small, reasonable gifts, sweet box, greeting cards, any type of things. India, not even, why even Diwali, even during New Year or something, or Sankranti, you give Tilgul, etc. So it's a part of the custom. It's not meant for giving benefit or perquisite to either the employee of the other, your customer, or to the customer per se. Having said that, now FAQ 1, 2, 3, etc. are very wide in scope. FAQ 4 says that the recipient, you should do the TDS in the name of recipient entity. So therefore, if you adopt this technical stand, it would be giving rise to litigation. You have to take a commercial call. If you don't want litigation, then you have to go as per FAQ 4. And under FAQ 4, what they have said is 20,000 limit has to be considered qua the recipient entity. So if you are giving gifts to, let's say, 50 employees in that organization, then 50,000 rupees, then 20,000 is breached. You have to consider, then you have to deduct TDS. But according to FAQ 4, you have to do TDS in the name of it could be distributor. So in the name of distributor, and then a distributor has to consider that gift, Diwali gift, as a salary TDS under 192, not under 194R.
It will be a long drawn case.
Sir,
It will can of worms.
Pradeep,
Yes, sir.
as the rule says that if the turnover should exceed 1 crore, then only is applicable, right?
That's right.
So if for this year it is exempt, means if my turnover being the first year, if it is the first year, there's 94 hour is exempt.
No, it says that you have to just like for computing 20,000 threshold, you consider the benefits which are given from April to June. So therefore, even if your turnover in financial year 21-22 has crossed 1 crore, then you have to start doing TDS from 1st of July.
Correct. But if it is not crossed, then this year this
No, this
90
year is exempt. This year it will be exempt. I think this is not a peculiar to this provision. Its same principle applies to a lot of other provisions also, 194J, etc.
problem is there, sir, and for TDS, everywhere it is written that is applicable or it is not applicable first year. But for TCS, nowhere it is written whether it is applicable for first year or not.
If you are speaking only on TCS on sales, I think the threshold is 10 crores.
Not TCS, that is a motor vehicle. For example, TCS on motor vehicle.
Okay. But that motor vehicle, I think, is also very peculiar transaction. 10 lakh rupees is the I think, vehicle. So there, I think this turnover criteria does not apply. So there, it's a high value transaction that they're capturing. More than 10 lakh rupees car, if somebody is buying, he must, there must be some income in his hands. He may have an advance tax obligation, and these transactions must be tracked. So therefore, you do that 1% TDS in over there.
Thank you, sir.
Please.
One more question. There are many industries where gifts are given to vendors, customers on their marriage. So, as a part of their marriage, personally, the income will be exempt because typically they have received this gift on account of marriage. But as a vendor, I will always debit it because I will always debit it to my P&L because I will treat it as an expense out of my customary business. So what will happen in this case?
No, again, I'm saying it is the same challenge as Diwali gift. It is the same challenge. All these gifts, etc., will have the same. Technically, I would agree with you that I can take a call that it is not given as a benefit or a perquisite arising from the business. I am giving it in his marriage. It is sort of for his personal circumstances, because you generally give a gift during a marriage. And in fact, under 56(2)(10), they have exempted gifts received during marriage without any limit. So therefore, it should not be considered as a benefit or perquisite in his hands. Is a technical argument which one can take, but of course subject to litigation.
Okay. I think we are done with the questions. Vijay sir.
Thank you, Pradeep, for asking the various difficult questions to the speaker. And speaker was answered in a simple and lucid manner. Now, some important announcement regarding the future seminars. On 6th of August, we have a GST assessment and issues in e-commerce, TDS and TCS. Then on 13th of August, we have a seminar on domestic transfer pricing and issues in tax audit and overview of model FS for non-corporate entities. Then on 20th of August, the seminar is on latest changes and updates in RERA, important judgments in RERA, and the new form 3 and 5. And what all precaution we have to take under the new form 3 and 5. So these are some of the seminars which are planned in the month of August.
Vijay sir, please also explain that on 6th August and 13th August, as per the institute guidelines, are physical seminar, and 20th August is a virtual seminar.
Okay, now I request our ex-deputy convener Pradeep Chandwani to propose a well-deserved vote of thanks.
Thank you, Vijayji. Well, it will be my honor today to provide a vote of thanks to the current speaker, CA Ravikant Kamath ji. Well, before the seminar, there were two discussions which we were internally doing. He said that at other forums, he has taken up this seminar and he has finished off maybe in 2 hours. But I am happy. He said that he will not play a 2020 game and he will play a test match today. I am sure that he is true to his words, but he has played test match like Virender Sehwag and not like Cheteshwar Pujara. So he has taken up so much issues that we never got bored during the seminar, and it was always raining 4s and 6s of all the queries, all the technical aspects of 194R. I must tell you, I was thinking that maybe I'll get 1 hour extra to complete my pending returns, but surprisingly, we have to extend the seminar for the questions. So it is I would say it is really an interesting take on 194R. And maybe I felt that if we would have given you more time, I feel that you would have taken more time today. So really thankful to you, sir, for a wonderful presentation, taking over all the questions and taking us really in depth to the topic and clarifying everything in detail. We are sure you have done a detailed justice to our topic. And a very special mention from CA Avinash Ravane. He has also complimented in the Q&A box that you have done very well. Of course, there will be other comments coming in. We are thankful to you, sir. With this,
Thank
we
you.
end today's session. Thank you. Thank you very much.
Thank you so much. Thank you.
Pradeep, we can end the seminar now.
Yes, sir.